Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know this morning.
First up, Bitcoin's tear continues. The digital asset topping $93,000 for the first time amid the election-fueled rally. The asset also gaining momentum as markets price in further interest rate cuts from the Federal Reserve following October's CPI print.
Plus, U.S. stock futures are fluctuating after the latest read on inflation, with October's PPI data showing that producer prices picked up in October. The hotter-than-expected data putting focus now on core PCE. That's the central bank's preferred inflation measure. Meanwhile, investors will be watching for comments from Fed Chief Jay Powell, who is due to speak later today.
And Disney out with fourth quarter earnings here. The shares of the company are moving after the company beat profit expectations and forecast earnings growth for the next 3 years. Disney's film studios and streaming business driving the earnings beat for the quarter, highlighting the turnaround taking place under CEO Bob Iger, who returned to the company 2 years ago. Iger's other chief priority is finding his successor, which the company will announce in 2026.
October's producer price index coming in slightly hotter than expected, calling into question potentially the Fed's fight against inflation. Month-over-month wholesale prices up 0.2%. Year-over-year numbers that came in just above the street's expectations. Joining us now, we want to bring in Stephanie Roth, Wolfe Research chief economist. Stephanie, it's great to have you here at the desk with us. So really over the last, well, longer than this, but especially over the last 24 hours, trying to figure out just where we are in the fight to tame inflation. What was your big takeaways from the PPI data that we got this morning and then also CPI yesterday?
Yeah, so today's data was a little bit disappointing. It came in a little bit firmer, especially for financial services and airlines, which is what we look to gauge where core PCE is going to come in at the end of the month. Those came in a little bit hot. On financial services, they were up 3% month on month. Domestic airlines, 2% on the domestic side. So that was definitely a little bit disappointing, which is why you see yields reacting. If you take a step back, combining CPI, PPI, generally speaking, a little bit disappointing, but okay. Yesterday's data was a little bit of a sigh of relief because everyone was worried it would be worse than expected. So if you take a step back, put it all together, a disappointing month for inflation, but not overly so, in the sense that some of it was kind of one-off stuff. So on airlines, hurricanes impacted vehicle prices. So the Fed probably still can cut in December. Their bias is towards cutting, but they'll probably have to go at a slower pace next year. So our base case is they'll cut at a quarterly cadence as opposed to every meeting.
Okay, and so with that in mind, I mean, what does that put your kind of terminal rate that you would be looking for the Fed? And especially once in December, we get the dot plot updates as well here.
Yeah, so what's interesting is what we learned from Powell recently is they're not going to put in anything on the fiscal front in terms of their forecast. He was pretty adamant about that. So we probably won't get an update in terms of how they're thinking about the election in the dots. But from our perspective, we do think that the Fed can still cut to 325, but it's going to take a lot longer to get there. So our base case is they'll cut 3 times next year, and then they're going to pause for several meetings until they see kind of how this tariff stuff shapes up. And the extent to which tax cuts, even though we don't think it's really all that impactful in terms of the economy, but how the combination of all of these factors really impacts the economy, then they can cut a couple times at the end of 2026, getting that to the 325.
So you don't see any material changes just in terms of your economic growth forecast or what you're seeing for inflation as a result of some of these fiscal policies?
Well, not exactly. Okay, so for 2025, our base case is kind of similar because a lot of these policies won't go into place. So the big thing for 2025 is immigration. At this point, the labor market's kind of back in better balance, so it's less impactful, less inflationary than many people fear. The other thing is going to be animal spirits. Hard to estimate that, but that could be a little bit supportive for growth for next year. 2026 is where Trump's real fiscal policies have an impact because that's when we're starting to talk about tariffs, and that's where investors are excited about tax cuts, but we're really only looking at about $500 billion worth of new tax cuts that we're estimating. So it's really not that big. So the net effect of that is kind of stagflationary for 2026.
So all that considered, I mean, you've mentioned both now on the inflationary side, what could be most impactful. And the thing that's contributed most to these inflation readings has still continued to be, at least within the CPI, shelter and shelter costs. And what we've continued to hear as a corollary is even if there were mass deportations, that could have an impact on the employment economy, but also on the housing and shelter economy as well. what would you be tracking for in any of those correlations that the market's trying to get ahead of as well?
So one thing that we've learned is that shelter inflation in CPI is not particularly helpful. We've been tracking real-time measures of rent, and Powell's mentioned this a number of times, that that's kind of most important, and for whatever reason, it's taking a really long time for it to impact the CPI shelter component. So we would be watching measures like Zillow in terms of rent inflation, what's happening actually on the ground. The one thing I would flag is the mass deportation concept. We really don't think that's particularly likely. It's more about a much slower pace of net immigration, perhaps a little bit negative in the first year or so, but then nothing like these mass deportations that some people are talking about.
So, I mean, there's been some conflicting, rhetoric coming out from policymakers here over the last couple of weeks, just in terms of how attainable that 2% goal is for inflation. How are you viewing that?
I think it's attainable. It might take longer to get there. It might be some bumps along the road, but we're very close to it. The labor market's not overheating. There are times where we're concerned about the labor market being too cool. Then you kind of get the opposite. And when you net it all out, you take kind of a smoother look at the economy. We're trending somewhere around 2 to 2.5% in terms of inflation, and that's not such a problem. Nothing like where we were.
From the wages component within employment, is what you're seeing within wages right now, is that supportive of what we've seen already in a resilient consumer that's continued to show up in some of the economic readings?
Yeah, we're seeing wage inflation somewhere between 3.5% and 4%, which is a very healthy pace in terms of wage inflation and nice positive real wage gains. So from that perspective, that should continue to support consumer spending, and it's not the type of wage inflation that the Fed is going to be concerned about. This is kind of what they're looking for, is 3.5% to 4% in terms of wage inflation. That's consistent with 2% inflation target, and that's kind of what they're looking for. So it's, dare I say, a Goldilocks type of employment backdrop.
Stephanie Roth, who's the Wolfe Research chief economist. Great to have you here in studio with us.
Great to be here. Thanks for having me.
Let's turn now to the market action following today's hotter than expected PPI report. Treasury yields rising after the increase in producer prices and putting focus on the Fed's rate path. We're joined by Michael Green, Simplify Asset Management Chief Investment Strategist here. All right, so you just heard the economic breakdown here on set, but as you kind of pair that with your own investment strategy going forward from here, what does that look like? What would you be prioritizing?
Well, the really key component, I think your prior guest nailed it when she said things look pretty good on the inflation front. Certainly on the worker wages, we're seeing some positive information that suggests that some of the weakness that we've been worried about in the labor markets has retreated. That's a very positive sign. The biggest question that we have is going to be the one around what happens with tariffs and what ultimately happens with deportations. Those are really going to kind of define the path of treasuries going forward. In both situations, we have conflicting components. Tariffs could be potentially inflationary. And unfortunately, deportations are really going to be a negative for the housing market, which has been that component that has kept inflation numbers so much higher. So as I look towards the back end of the year, I think a lot of what we've seen in rates has been simply a repricing of a very aggressive move that has occurred. I'm not sure that I would interpret anything that's happening in the rates market as anything other than a fairly substantial give back of that on the recovery in the economic conditions that your prior guest hit on.
So, Michael, how should investors then be thinking about the investment landscape right now, whether or not some of that momentum, especially the Trump trade, does it have legs? It sounds like it does.
Well, I think that there are elements of the Trump trade that could very well have life. The question on the markets itself, the equity markets are at extremely high valuations. At the same time, people are being offered yields in 10 years and 30-year bonds that now actually in many ways allow them to meet many of their retirement goals. We're seeing expectations continue to bubble up. We're seeing surveys that suggest investors' expectations of long-term returns are rising. All else equal, that suggests to me that we should be very cautious about equity exposure, and we should look at much of what we're seeing in the fixed income world as an opportunity to de-risk portfolios while still earning a very attractive return.
It sounds like you're really focused and kind of trying to make sure that there's a barbell approach to where there is risk opportunity that will see reward versus where you would just like to make sure that you're kind of taking advantage of, even if it might not be the sexiest trade out there, one of the most stable trades out there. How are you kind of making sure that you're diversifying even in an environment while also making sure that you're taking on some risk?
Well, I think you nailed it when you said the barbell portfolio, because ultimately what you want to have is you want to maintain some of that beta exposure. You want to make sure that you're not, panicking and running out of equities. But at the same time, the extraordinary gains that we've seen with the S&P up 25+% for the year and over the past several years having delivered a near record performance, a lot of that has been on the back of valuation expansion. We just have not seen the earnings come through in the manner that was projected. If we go back 2 years ago, we were supposed to be at $270 in the S&P for earnings at this point. Instead, we're looking more like $220. So a lot of the expectations that are built into equity markets suggest that this is an element of mania that's catching hold at this point. And if you're going to play that, play it with some safety. Take advantage of the fact that implied volatility is relatively low. Consider owning calls rather than stocks, and don't neglect that fixed income portion of your portfolio.
Michael, what about the crypto side of things? You've got Bitcoin on this relentless rally and march higher, now right just below that 91,000 level. Is that an area that investors should be looking to gain a little bit more exposure to?
Well, I have to be very candid. I've been very negative on Bitcoin. Clearly, the price appreciation has been extraordinary, but that has come, unfortunately, on the back of flows coming from retail. So we are seeing evidence that the ETFs are being used for exit liquidity for other holders of Bitcoin. Ultimately, we still do not have a use case for it or the opportunity to generate any returns associated with this underlying product. And as a result, it really just boils down to a question of, do you think that you can get out before the next person does?
Okay, and so is there still, as we're kind of looking at 90,000 Bitcoin, 90,000 US dollars at least for Bitcoin this morning, what needs to happen? Because it kind of comes back to what you were talking in terms of the valuations that have run so fast and so quickly, and now the growth into some of these valuations. What do you think needs to happen then within crypto for it to actually validate what we're seeing right now at one Bitcoin for $90,000?
Well, there are two components that could ultimately end up happening here. One is that Bitcoin was originally designed as a peer-to-peer payment system. It has failed in that front. It is not used for peer-to-peer payments. It is banned in many places for a variety of reasons, the fraud component being one of them. The issue that leaves effectively the component that people are angling for at this point, that it becomes a leverageable asset, that theoretically your stock of Bitcoin could be lent to somebody else who wants it or needs it in some way. And unfortunately, that becomes just a circular logic, because if it's not ultimately useful for payments, then it becomes a question of what do people actually need it for. There's plenty of collateral out there in the world. US Treasuries are obviously sitting at the base of that right now. The Bitcoin play and America's embrace of it is a very odd one if we decided that we ultimately wanted to undermine our own positioning in terms of the reserve asset. So we'd have to see that component ultimately play out.
Michael Green, it was great to get your insight here this morning. Thanks so much for joining us. Simplify Asset Management Chief Investment Strategist. Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street right now. You're looking at a mixed picture for futures. You got Dow and S&P futures on track to open in the green. You got NASDAQ just below the flat line. First, we're going to bring you the latest on Disney's results and hear from CFO Hugh Johnston. And Tapestry and Capri calling off merger talks, citing regulatory hurdles. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. You can do all of this with Yahoo Finance's trending tickers page. First up, let's take a look at Tapestry and Capri calling off their planned merger after the deal was blocked by the FTC, citing reduced competition in the luxury handbag market. In a statement, Capri saying that the two companies mutually agreed to terminate the agreement, says it was unlikely to get regulatory approval before the deal expired in February. You're taking a look at the stock's reaction to this news. You have Tapestry moving to the upside, you have Capri moving to the downside here. Lots of questions, I think, for both companies, but let's zero in first on Capri, just in terms of how competitive they are able to be without this tie-up here with Tapestry. That is something that investors are trying to figure out. Analysts are working through here this morning. Many analysts coming out and saying that they actually think Capri might need to sell off some of its brands following this failed merger. Capri does see Michael Stores' fleet planning to cut their number of stores to 650 stores over time there, so downsizing their real estate footprint, and exactly what that tells us about maybe demand longer term or more of a murky outlook here over the next couple of quarters or potentially several years. But again, lots of questions about what Capri is going to look like. And to no surprise, in news like this, you do have Tapestry moving to the upside. The company also announcing an additional $2 billion in share buyback authorization.
Yeah, you see this come across this morning, Shauna. And I mean, honestly, I just have one of those moments where you kind of take your Versace scarf and you just scoff and toss it over your shoulder because,
Bougie of you.
Yeah, I know, right? Well, this is the companies that we're talking about. At the end of the day, the company's chairman and chief executive officer, John Idle, saying at the end of this, the termination of the merger agreement, they're now focusing on the future of Capri and their three iconic luxury houses. You saw them there on the screen. And there you're taking a look at who may have needed this deal just a little bit more here. But ultimately, I think for Tapestry and Capri, it now becomes a question of how do you really, in a consumer environment where, regardless of the income cohort, there are more decisions being made about that discretionary spending and what a pullback for any of these companies, either of these companies, would look like here. And so ultimately, I think for the strategy update that they provided along with this, where they're going to lean in, communication, product strategy specifically here, trying to create exciting fashion product that resonates with their consumers. Oh, by the way, the consumer that you've been able to sell into for decades at this point is aging and probably has enough of the Versace gear or any of the other iconic brands that they do sell. And so now it's, all right, how do you go out to a younger demographic that knows these brands but is more reticent maybe to make as many purchases right now because there are other purchases that are being prioritized in the family formation stages for millennials as well. Gen Xers, do whatever you want with your money. A lot of people haven't paid attention to you, and it's probably a bad thing actually for companies like Capri and Tapestry, but maybe they'll get a little bit more of the inclination to go after your mind share as well. Interesting performance over the last 18 months. This is the last thing that I'll mention here. They've recently started to implement some of these strategic initiatives, and we'll see if these luxury houses can get back to growth.
I think right now they're very much stuck in a tough place, right? They're not the highest end here of the luxury bag market. They're also not the lower end. So they're stuck in this middle market category. You're in a tough macroeconomic environment right now. Many people are trimming their discretionary spending, and unfortunately, it's names like Tapestry, it's names like Capri that are feeling some of that, the hit the most here, just in terms of how troublesome and how worrisome the next couple of quarters could be, just given that broader macro environment.
Yeah, it may also look like a re-strategizing around their global footprint for brick and mortar as well, because of the way that consumers are shopping, more of the real prioritization on that digital body language that you're seeing from a potential shopper and being able to create more valuable experiences there as well. All right, all those things considered, let's talk a little ASML here. Reaffirming its long-term outlook, betting on continuing demand driven by AI. Now, the Dutch company that makes chip equipment, it expects to sell and will have sales range between roughly $46 billion and $63 billion in 2030. Now, this does come after the company cut its sales outlook for next year. You're taking a look at shares. They're actually up by about 4.8% right now. One of the things that was pointed out here within this update, the company looking for growth in semiconductor end markets as well, increasing lithography spending on future nodes. That's what's kind of giving them some of this confidence and strong demand for their products and services. Lithography, very important to the future of chips and just being able to print, produce, and manufacture chips at scale.
Yeah, the company here pledging to grow their dividends or share buybacks. That's two things that the street really likes and is excited about. You take a look at this longer term outlook, the fact that they did reaffirm, the fact that they are looking ahead to 2030, saying that they actually see AI demand boosting global chip sales to over $1 trillion by 2030, representing an annual growth rate in the chip market of just about 9%. That's putting to ease some of the fears that we did see surrounding ASML last time they did give some guidance. So again, a bit of a reassurance here for the street. That is why we are seeing the stock react the way that it is. When you take a look at that longer term chart, though, it's still a stock that has been under a bit of pressure, off just about 26% over the past 6 months, still in the red since the start of the year. And here we are, at least at the close of yesterday's trading day, it had closed up at just about 0.6% at 673. But again, this slight move higher here that we're seeing in the pre-market. Let's get to NVIDIA. Its price target raised at HSBC to $200 from $145. The analyst citing more AI-driven growth to come and also expecting more upside in data center momentum. Why this is so significant, it actually matches a street high here just in terms of what analysts are expecting over the next 12 months here for the share price. So again, they're seeing shares climb quite a bit from here, up to $200 a share. The analyst there, Frank Lee, saying that he expects more upside in data center momentum, noting the third quarter 2025 sales and fourth quarter 2025 guidance are actually on track to beat expectations. So lots of questions about what exactly that growth is going to look like for quarters to come, whether or not it's not only going to be able to measure up to the street's expectations, but surpass the street's expectations. Two things that we have very much seen as a theme here this past quarter, really has been a theme for NVIDIA now for a couple of quarters in a row, just in terms of how fast and furious the stock has risen over the last couple of years. It's not good enough just to beat expectations. You have to beat by a significant amount and also prove that revenue growth will continue.
Yeah, 4 words stuck out to me here, and I mean, you summed it up perfectly. No signs of slowdown here, and that's essentially what they're pointing out here, saying, in part, we've pondered this amazing growth trajectory, and not only do we see no signs of slowdown, we expect further upside in fiscal 2026 data center momentum, which in our view is still not fully priced in by the market. That coming from the analyst at HSBC. Wedbush was also out with their own call this morning as well. They raised the price target to $160, but again, that's not the street high as of right now for NVIDIA.
Yeah. Lee saying that the AI train is back on track.
Hey, whoa, whoa. No.
We're going to leave it there.
I'll see myself out.
There you go. All right, we've got much more coming up here on Yahoo Finance. We've got the opening bell in just a few minutes. We'll be right back.
We'll workshop.
You want to do it again?
No.
Woo woo.
Woo, woo.
One of the hottest stocks on the Yahoo Finance platform this morning are shares of Disney. The stock is ripping higher after an earnings beat and some very, I would say, upbeat, forward-looking guidance from the company. Let's get right to Hugh Johnston, the Disney CFO. Hugh, always nice to, or I should say always a treat to get some time with you here. I think this stock, and you can correct me if I'm wrong, I think it's trading off of what is transpiring in your entertainment business. When I last talked to you a couple months ago, the momentum seemed to be gathering in the studios. It looks like things picked up a gear. Is that the correct assessment?
I think that's fair, but not complete. I think there's a couple of things going on right now. Number one, obviously, 2024 was a terrific year, and Q4 was a great cap to a terrific year. 6% revenue growth, 21% OI, and then, of course, 39% EPS growth. And in terms of the way we thought about the business, you know, we've got two back-to-back billion-dollar movies. We've got terrific things going on with women's college basketball and college football. So certainly feel great about all of that. In addition to that, the streaming service now has turned significantly profitable for 2 quarters in a row. And then, of course, we had a record year in the experiences business. And then last but not least, streaming, we added about 6 million subs over the third quarter. So I think it's a combination of all of those factors and the portfolio working. That fact that we've been investing in those things as well and the fact that we've got sort of good visibility into the future is what has led us to provide forward guidance. And I think the confidence that we have in those investments, whether it's the investments in streaming or the investments in the experiences business, is what's leading investors to basically look at the guidance and say, yeah, this is something that we're really bought into. We feel very positively about it. So certainly the creativity that's coming out of the studios, and then it just sort of plays its way right through the entirety of the Disney company.
Can you just sit here today and say that the entertainment business has its magic back?
Yeah, I think in many ways it does. And you probably need to kind of go back a few years as to how we got there and then how we've gotten here. In many ways, when you think about where we were a few years ago, we were producing a lot of content to try to fill the streaming service. And we stretched ourselves in some ways probably too thin. One of the things that Bob Iger said when he came back is, I want to put creativity back into the center. I want to reduce quantity, and I want to upweight quality. And we've been saying that for a few quarters. But now I think the combination of Inside Out 2 and Deadpool and Wolverine and the 60 Emmys on television from the combination of Abbott Elementary and The Bear and Shogun, of course, now we have the proof points there. So yeah, I do think that focus on raising the bar on quality and delivering really, I think, the best content in the industry is an indication that the magic is back at Disney.
Hugh, I never felt older when I saw the recent Lion King trailer. I remember this came out, 1994? Now this lion is all grown up. I mean, but is that movie, can you single that out as potentially the biggest blockbuster coming from Disney over the next year?
Boy, I sure hope so, but I'm not going to go so far as to project that. I do think Moana 2 is also going to be a huge hit. And then we've got Avatar coming next year, as well as Lilo and Stitch and Captain America. So I'm optimistic about the portfolio. I think the slate we have going into 25 is absolutely outstanding. And as good as 24 was, I think we feel probably in many ways even better about 2025 in aggregate.
Are you beyond the low point in the experience business? When I talked to you 3 months ago, Street was very focused on that, maybe didn't get the results you thought. What stood out to me in this business, Hugh, in this quarter was the international under pressure. Where is that pressure coming from overseas?
Yeah, happy to talk about that. I do think we're on the upswing in experiences overall. We obviously saw growth in the domestic parks and certainly feel very, very good about that. International is relatively easy to identify 2 factors. Number one was the Paris Olympics, believe it or not. Whenever we have an Olympics in the same town that we have a parks in, attendance suffers. And we expected that, we forecasted that, we shared that expectation with the Street, and it came in basically exactly where we said. Second was Shanghai. We saw some softness there as well. Given it's China, we think it's temporary in nature. We think the consumer will come back. There's certainly a lot of love for Disney in China, and our expectation is the Shanghai park will come back. The Paris park has already come back, so we certainly feel good about that. Once the Olympics were over, we saw the attendance come back relatively quickly.
I'm curious on your longer term thinking here. Earlier this week, Hugh, we had our Invest conference, talked to a lot of really amazing leaders, and I got the sense they weren't thinking about geopolitical risk after the election. You know, as you look at a business like Shanghai Disney and your international operations, if things heat up, do you see a line of sight to an impact to those businesses overseas? Do sales take a hit? Do profits take a hit?
I really don't. Let me tell you why. You know, if you think about what the Walt Disney Company is all about, we're about bringing smiles to people's faces. We're about creating moments for families. We're about creating joy. That's not a political thing by any stretch of the imagination. And frankly, I think most political leaders would look at Disney and say, you know what, that's something that I want to make sure our citizens get to enjoy. So I do think we sort of fall outside of that realm because of what we bring to families and what we bring to consumers.
No better person to ask than the CFO of Disney. And of course, thinking back a little bit to your long time at PepsiCo as the CFO, tax rates. If tax rates come down under the incoming Trump administration, what does it mean to a Disney bottom line? And have you factored that into your longer term guidance?
We haven't factored any change in tax rates into our guidance. So, you know, we'll see how that plays out. I mean, we're exactly 9 days post-election. I think it's a little bit early to be speculating on just about everything related to Washington. So I think we just need to be patient. Let's see how the facts play out. And if tax rates go down, that's obviously a great tailwind for us.
On the TV side of the business, I think the street knew what was coming. I mean, the sales were under pressure again. The profits were under pressure. What else needs to be done? I mean, you have the transition to streaming, so it's maybe necessary. It's hard to stabilize that top line, but like, is it time to go deeper on the cost side of this business and cut more costs?
Well, I think we're always going to look hard at cost, but one of the things I think it's important to do is step back a little bit from separating linear from streaming. Because if you look at a lot of the content that we create, whether it's in news, whether it's in ESPN, or certainly whether it's in the studios, it plays across both distribution channels. You know, when I came to Disney back about a year ago, Bob asked me to take a look at the whole concept of linear and should it be separated and all of those things. And I did a lot of deep analysis on it and came to the conclusion that it really wasn't a good idea for us to do that. And, you know, anyone can kind of do spreadsheet math and sort of make assumptions and make a deal look good. But as I looked hard at it, from a financial perspective, I didn't think there was going to be any value creation. And from an operational perspective, you create so much more complexity by creating that type of a separation. So, no, the conclusion I've come to is we actually have a natural hedge. To the degree that linear does better, fine, then we'll do great with that and streaming gets less. To the degree that linear does worse because the consumer is choosing to go over to streaming, that's fine. We have the natural hedge on the streaming side. I think the core for us is really the content creation that comes out of our networks. It plays across both distribution channels, and that's really the most important thing.
Well, how do you improve the economics of that business looking out longer term? If it's going to stay on your balance sheet, I mean, how do you show or present something better to investors?
Well, I think the way investors should be thinking about it is at the entertainment level. So we've guided on entertainment to double-digit OI. And as we think about sort of entertainment, it really is much more of an integrated unit as opposed to just sort of focusing on one individual line item. I'd look at the collective and say, okay, does this portfolio work? And for us, it does. Now, I know there are other folks in the industry who are thinking about it differently, and they have different assets, and it may make sense for them. And candidly, we're always going to be open, and we have an obligation to listening to ideas. But we've got a pretty firm conclusion that the portfolio we have right now is one that's going to work and work really well. So I wouldn't expect us to make any changes there.
Lastly, Hugh, since we last talked, there's been a whole, I guess, a sea change on how people are viewing or what's being seen on Twitter or X. You know, I've seen videos of Disney characters. I mean, it's horrible stuff. I mean, as a Disney executive, what do you think about what is going on that platform, in the media and the content it's creating? And do you have any appetite to get back on there and advertise?
You know, I haven't talked to anyone recently about advertising on X, so I'm not sure where we stand on that one, to be honest with you. Overall, obviously, we're mostly concerned about defending our IP and ensure that our IP is used appropriately, and that's something that we'll certainly do everything we can to do. So regarding the future of where our advertising budgets are going to lie, I won't get into that one today.
Fair enough. All right, well, good quarter out of Disney Co. Hugh Johnston, CFO of Disney. Always nice to get some time with you. We'll talk to you soon.
Great to be with you, Brian.
Appreciate it. All right, guys, back to you.
All right, Saz, thanks so much for bringing us that interview. We want to kick it over to Jared Blickery. He's keeping a close eye at the markets here, 8 minutes into today's trading session. And Jared, what do you have your eye on?
Well, we have a bullish start to the day, although the S&P 500 just barely in green territory. So is the Dow. For the week, we're going to see the S&P 500. It was in negative territory, just slightly, 15 basis points, not a whole lot. And you're going to notice the swings this week have been very mild compared to last week. Let's just take a 10-day look, and you can see we are right near recent highs. So this week is just a consolidation week. I do want to point out the Dow is flipped positive for the week, and we'll put a 4-day chart to show that here. There you go, up a whopping 3 basis points. Russell 2000 was lagging yesterday, so let's check out that as well. Into the red for about 1.2%, although it is just barely green today as well. Let's go over to the VIX now. I've been tracking volatility, and that has been sucked out of the market. This is a 4-day look. Let's put the 10-day so you can see what happened in the election. We moved down substantially last week, and now we are just kind of hanging out and pressing new lows. We got below 14 with a 13 handle yesterday. Haven't seen that in at least 4 months. So that's something to look out for. But just kind of speaks as to the risk-on flavor of the markets. Here's the B of A move index that has dropped as well. That's like the VIX for the bond market. And let's get over to the 10-year yield because that is at a 4-month high. I'm going to put a 3-month chart, and there we can see 4-month high. So we've been talking about the stronger rate picture. Is this reflecting stronger growth in the U.S. because that can be very supportive for equities? Or is this big movement going to cause equities to roll over? And that's something that we've seen in the past as well. So far, it seems risk on, and the higher dollar as well, not really impeding things. Although if I put a 5-year chart, you can see we just got to some relatively pretty strong resistance there. So we'll have to see how that evolves. Wouldn't be surprised to see the dollar slow down and possibly even roll over. Got to get to some of the sector action. Communication services in the lead, up 0.4%. Energy also green. Everything else in the red. Real estate leading to the downside, down 0.2%. And also want to point out that XLY has been really switching places recently. It's been a leader since the post-election period. And let's just check out the 4-day stats there, up 1.5%. I'm going to take us out on Bitcoin because Bitcoin is holding 90,000, just been in an incredible tear here. But of course, the big number, 100,000, that's still 10,000 to go or thereabouts. Guys.
Jared, thanks so much. Taking a look at some of the early trading activity that we're seeing here today. Coming up, we're taking a look at how President-elect Trump's policies could have a major impact on some tech names, including Apple. That's next on Morning Brief. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at energy. Hey, Maddie.
Hey, Brad, thanks so much. So I want to talk about the energy space because of Oklo. And really interesting news out of this company today, backed by Sam Altman. This is one of the nuclear plays in the space. They solidified more deals to feed data centers with their energy offerings to the tune of about 750 megawatts of electricity coming from planned nuclear buyouts. So that stock is ripping today. But as we're kind of entering earnings season for some of these big nuclear names, I just wanted to give a little bit of context here with our chart of the day. And this is a chart that's going to be comparing Constellation Energy, which, as you can see, ripping over the past couple of years here. And then we've got the sub-industries. So just taking a look at the electric utilities indices in comparison with this individual stock here. It's a little bit hard to see on this chart, but this is still a huge performance here for the sub-industry groups. You've got the S&P 1500 index, which tracks utilities in the electricity space, specifically up nearly 80%, but that obviously pales in comparison to the nearly 500% gains that you're seeing over the past 4 years rather, through Constellation Energy. And the takeaway from this chart from the analysts over at CFRA is that you should actually be stock picking within the space. They're neutral on the overall index, and that's because of a couple of headwinds that we still have in nuclear. We don't actually have a lot of the infrastructure that these nuclear companies are investing in. They're building them out, but it's not a proven use case. And this is exactly what I was able to speak with Tom Steyer about at the Invest conference. I asked him specifically about what he thought about what's coming next in nuclear energy, and here's what he had to say.
Just being part of the energy transition doesn't necessarily mean that it's a good investment. And so what we've said is we want to be invested in things that will have an impact this decade, which honestly, I think you'd have to be awfully aggressive to think that fusion will. We've looked seriously at fission, but as these things happen, we're going to react to the pricing and the opportunities and the risks.
So I was fascinated by that from Steyer, kind of throwing cold water on the nuclear rally that's brought stocks like Constellation up so much year to date. He's saying he's invested in kind of the bread and butter of what's next in this energy transition. Shauna.
Yeah, man, it was a great conversation. Thanks so much again for recapping that and showing what exactly those outcomes could look like. Let's take a look at President-elect Donald Trump. He is set to take office in January, and Tesla CEO Elon Musk's role in the Trump administration, plus expectations of lighter regulation, well, that has put Trump's relationship with tech in focus. I got the chance to speak with IBM CEO Arvind Krishna about this at our Invest conference earlier this week. Here's what he had to say.
I think that we are all hopeful that there is going to be a lot more innovation and there is going to be less regulation. Those are both good for business across the board. I always acknowledge we need some guardrails. I always think, at least in the United States, with our system of separation between the judiciary and the legislature, there'll be some guardrails. But I'd say the business community overall, and us especially, are excited that we think there will be tailwinds to the economy going into 25.
Joining us now, we want to bring in William Kerwin. He's Morningstar's technology analyst. And William, I want to start there. Just talk about the implications of the second Trump administration, what exactly that means for big tech. Is it going to be different, do you think, second time around?
Well, a lot remains to be seen, obviously, but the word that comes to mind is tariffs and how those might impact companies. So when we think about a company like Apple, which is the largest tech name under my coverage, they were able to get away pretty much unscathed in the last Trump administration without a large tariff impact. It remains to be seen if that'll happen again this time, or if it may be different if we see a blanket tariff that could have a larger impact on Apple. So for that company specifically, we expect them to continue diversifying the supply chain outside of China into places like India and elsewhere in Southeast Asia. And we think that'll be a trend really across the sector, trying to avoid that manufacturing concentration, specifically in China.
One part of it is the manufacturing concentration. One part of it is also just the U.S.-based companies that have the most exposure to China, either through their revenues or through how they're trying to position the next leg of growth. How are you evaluating that?
Certainly. So, one sector that comes to mind here is chip equipment. So these are U.S. names like Applied Materials, which actually reports tonight, Lam Research, KLA, that reported a couple weeks back. These companies have as much as 30% of their revenues out of China. So it's a question we get from investors a lot. But when you actually unpack that number, a lot of that sales exposure into China is what we call lagging edge equipment. So not cutting edge, not producing AI related chips, really producing more basic chips for autos, for industrial applications. So, even though there's that high exposure, we don't necessarily see it more at risk from national security restrictions and trade tensions. So you really have to unpack what's in that exposure. And sometimes even that high exposure, we don't think equates to necessarily a high risk.
William, one of the things that Arvind Krishna told me was just in terms of this expectation of lighter regulation. And I bring that up just through the lens of antitrust regulations and ultimately what that could mean for big tech down the road. Do you see more opportunity or an expectation of an uptick here in M&A deals, given the fact that we are seeing a changing of the guards in the White House?
I think it could go both ways, quite frankly. Something that stood out to me is actually, Vice President-elect J.D. Vance's comments complimenting current FTC Chair Lina Khan about her approach to antitrust regulation for big tech, like against Google, like against Meta. Now, we think the focus on quote unquote big tech will really be focused on platforms. So again, Google, Meta, and their use cases. We don't think it'll focus on a product or a company, like Apple, which really is concentrated in products rather than platforms. So we think there could still be some antitrust against the largest of tech companies. But to your point, we think M&A deals at the rung just below those largest of large tech companies can start to pick up again over the next 4 years.
Do you think that means potential breakups of some of the larger platform technology companies?
I think I'd be hard pressed to see a complete breakup, but I mentioned Google, and the example here is there's an ongoing case from the DOJ about Google's exclusive payments to Apple to be the default search provider there. We think that can result in Google no longer being able to have that exclusive agreement and opening that up. So, that's an example. It's not a complete breakup of the company, but there are measures that can be in between there that still erode at the moat a little bit, but don't result in a complete breakup.
William, as you talk about who is best advantaged at this juncture, not only given the change that we are going to see in the White House, but also just some of those broader macro trends that we, of course, have been closely following, who do you think is best positioned here in terms of an investment opportunity heading into 2025?
Well, really, the trend still, when I think about the technology sector, is AI. And the truth is that most of the firms that we see being well-exposed AI beneficiaries are overvalued today. But that doesn't mean there aren't opportunities here and there in the sector. So a couple names that I really like are, one, Lam Research, one of those chip equipment companies that I mentioned earlier. We think the chip equipment group has sold off a little bit over worries of cyclicality, worries of AI reaching maturity that we think are unfounded. So we see some value there. And then even outside of AI, a company like onsemi, I think a name that I've spoken about on this show in the past, not really well AI exposed, but exposed to trends towards electric vehicles, industrial electrification, and we see that as undervalued too today.
William Kerwin, who is the Morningstar technology analyst, joining us here this morning. Thanks so much for hopping on Yahoo Finance with us. Appreciate it.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds apiece. Let's go. First up, let's talk a little Meta. Meta Platforms must face an FTC antitrust lawsuit accusing the company of acquiring Instagram and WhatsApp in order to stifle competition and dominate the social media sphere. A U.S. district judge on Wednesday denying Meta's motion to end the case, ruling that it must go to trial. The judge did narrow other claims against the tech giant within the lawsuit, dismissing the FTC's allegations about restrictions with third-party app developers here. Shares right now of Meta are down by about 0.4%. As part of this, it seems like Meta is confident that the trial will reveal that the acquisitions were ultimately positive for the larger marketplace out there.
Yeah, and that's not all when it comes to some of these regulatory pressures facing Meta right now. Also overseas, when you take a look at the EU hitting Meta with a $841 million fine tied to its Facebook marketplace service and sprawling social networks. So lots of questions just about the dominance that they play in this role for the marketplace. Facebook, or Meta, has vowed to appeal this decision, something that could take months, not only months, but years to play out. But again, that's one of the reasons I think that we're seeing the stock under a bit of pressure here this morning. Let's take a look at JD.com. JD.com's revenue growth is surging 5% in the quarter. The CFO attributing some of that growth to a rebound in electronics. Home appliance sales sustained momentum in general merchandise. Investors looking for more evidence, though, of a broader spending rebound in China. So that was a huge disappointment. And that's really the headline here coming from this report, why we are seeing shares off just over 6%. Moderate expansion. I wouldn't really say it was a tremendous amount of growth at 5%, right? That's pretty moderate in terms of JD.com and what we have seen in the past. So, of course, that suggests the fact that Chinese consumers still staying on the sidelines. They're a little bit hesitant to spend. And as a result, we're looking at the stock under a pretty significant amount of pressure here this morning.
Yeah, just a couple days after Alibaba and JD.com said that they had record singles days. Yeah, all right, big shopping. And finally here, speaking of shopping, famed hedge fund manager David Einhorn revealing a big bet on agricultural firm CNH Industrial. Einhorn saying at a CNBC conference that he expects the stock can double in the next couple of years here. Shares right now are up by about 6% here during trade, and of course they were seen climbing pre-market as well now that we've begun trading. Of course, this really brings back to the thought of how Einhorn sees this brand growing out, saying it's exactly the king or the kind of situation that absolutely nobody cares about right now.
All right, well, that does it for Morning Brief. You got to stop talking. It's time for me and my co-host at Madison Mills. We're going to kick it off with Catalyst at the top of the hour. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, we're going to bring you the latest on the crypto rally as Bitcoin tops 93,000. We're going to discuss all of that with the GM of Robinhood Crypto.
Plus, we'll discuss the state of corporate governance at Tesla as Trump taps Elon Musk for a government role.
And we sit down with the CFO of Cisco as the company's tepid forecast outweighing strong quarterly numbers.
Let's get right. At the 3 major averages, a bit of a mixed reaction that we were seeing at the open. If we go throw up the 3 major averages here, all right, we have all 3 of the major averages actually moving to the downside here. The Dow off 0.1%. You've got the S&P off 0.1% as well. The Nasdaq also a bit of pressure. The move lower coming as inflation does in fact remain sticky. Producer prices rising 2.4% from a year ago. That was slightly hotter than what the street had been anticipating. We want to bring in Brent Schutte. He is the Chief Investment Officer at Northwestern Mutual Wealth Management Company. And we also have Kevin Flanagan, head of fixed income strategy at WisdomTree. Guys, a lot to get into here this morning. Brent, let me start with you just in terms of the market's reaction here this morning. A bit of a reversal. Looks like the market is taking a bit of a breather. Should we be reading any further into today's action?
No, I don't think so. You've come a long way in a short period of time based upon hopes of what could possibly be in the future. And I think now it's more of a show me. The reality is inflation remains high. It remains sticky. The Fed's job is likely not done. And even though they've cut by 75 basis points, I know that the 10-year Treasury has risen by 85 basis points. And so that's the riddle going forward. How does the Fed, how do rates move lower and help parts of the economy that haven't done well because they've been impacted by rates? And that's the riddle going forward. And I just think it's time for a pause in the stock market.
I want to get your take on this too, Kevin, from a yields perspective. We obviously saw yields moving higher on the back of that PPI figure. Is the Treasury market telling us a growth story or flashing a warning signal about inflation?
Well, I think it's a little bit of both, right? I mean, the narrative that we had during the summer when the 10-year rallied about 100 basis points, none of that was validated. And we continue to see a resilient economy, a labor market that's not cooling as expected. And to your guys' point, inflation kind of getting stuck right here. You know, if you look at core CPI, the numbers last 6 months between 3.2, 3.4% year over year. So I think what the market's telling you is that, hey, this rally wasn't validated, and looking ahead, you know, some concerns that perhaps if in fact the red sweep produces what Trump was talking about, some of those policies are being viewed as inflationary.
Are you viewing them as inflationary, Kevin?
Nah, you know, we have such a long way to go. You know, I don't want to get ahead of myself with that. I mean, legislation takes a long time to pass, right? We don't know what we're going to get from that. So I would think at this stage of the game, at a minimum, it's kind of neutral to maybe pro-inflationary.
Well, something else that is factor in the inflation discussion is, of course, the deficit, top of mind for a lot of investors, especially as we know Elon Musk is attempting to tackle $2 trillion in costs in his new role. Details remain to be seen, but economists expecting President-elect Trump's tax cuts to be a little bit of a ballooning factor for the deficit. We spoke with experts at Yahoo Finance Invest about the outlook for the deficit. Here's what they had to say.
We are, at the moment, running circa a $2 trillion deficit. We've waited too long to fix underlying problems so that small amounts of tinkering are unlikely to result in directional change.
I think getting the balance right of spending containment, tax receipts, clarity and getting the condition there, whether it's cutting rates or simplifying the code and generating other ways to make sure you have it. But you need more revenue, and you also need to manage expenses. There's no other way to do it.
The long end of the yield curve, to me, is where you got to be really, really careful and really thoughtful about it. We go through auctions, you know, sizable treasury auctions, almost every day. You got to instill confidence, and I watch these auctions, particularly further out the yield curve, like a hawk.
So, Brent, I want to go to you on this. If we have investors who are watching treasury auctions like hawks, sussing out when the deficit issue is going to become a problem within the Treasury space. When does the sort of lift that we continue to see in yields become a problem for the rally we're seeing in equities?
I think it will become a problem just because right now, if you look at bonds and you look at the earnings yield of the S&P 500, the earnings yield of the S&P 500 is below bonds, which historically there have been periods of time where that hasn't been an issue. That's been because bond yields were moving lower at the same time. Look, to me, right now, if you look at the stock market, the S&P 500 trades at expensive valuations. It doesn't trade at valuations that make sense with a 4.5% 10-year Treasury yield. And so either the Treasury yield has to move lower or valuations have to either be grown into by earnings growth or pulled back. And that's where I think the conundrum going forward is. And I think investors, despite the reality that, yes, deficits are becoming more and more of an issue, I think they still need to invest in fixed income because I do think it's something that's going to have to be dealt with, which we can as a country. And that's where I think there's still opportunities across the yield curve, not just at any one point, not in just hiding in the front end. Who knows what happens in the future, and just make sure that you have treasuries across the curve that match the duration of your liabilities or when you need those.
But Kevin, in terms of utilizing what we're seeing in something like Treasury auctions to suss out the health of the economy, are there any risks ahead that you're concerned about?
Well, I think you need to put the deficit and attendant increase in Treasury supply kind of in some perspective. Usually what we've seen over the course of at least, post-war modern financial history, it's the macro, it's the Fed, it's inflation. That's the primary driver for interest rates. The deficit, supply, secondary or tertiary. Perfect point. Last 12 months, we've had 2 different rallies in treasuries worth 100 basis points with record coupon supply and, as we heard before, baseline $2 trillion deficits. So that's the point that I was kind of making before too. How do we get from 2 trillion to 4 trillion? I don't know if we're going to get there, right? So much has to be filled in on the legislative front on that backdrop. And to the point, watching auctions, yeah, we should be watching auctions, but I don't think we're going to see any failed auctions going forward. But could the bond market send a signal, a shot across the bow that, hey, you guys need to calm down a little bit here, and we go to 5% or somewhere around there, or maybe above on the 10-year Treasury? That's what I'd be watching for, that kind of a signal.
So, Brent, given all this and given the fact of where we are, current valuations right now maybe a bit stretched to some at least, how should investors then be approaching 2025?
I just think a little bit more of a caution and a reality that no one knows exactly what's going to happen for sure. Look, I believe in diversification. We believe in diversification. And this is the point in an economic cycle, which I think we are later in an economic cycle, where investors are tempted to concentrate in one particular asset class or a narrow sliver of an asset class. And that historically has led to disappointing returns in the future. And so stay diversified. Understand that while large cap stocks are expensive, there are opportunities in small and mid cap stocks. And that fixed income, if you need the money in the near term, despite the deficit worries that I have and that others have, is still a good asset class as long as you remain more towards quality.
All right, Brent Schutte, always great to have you. Kevin Flanagan, thanks so much for hopping on with us here this morning.
Thanks.
Let's do a quick check of the market sponsored by Tasty Trade, taking a look at the major average here. Again, under a bit of pressure following the latest inflation data that we got out this morning. PPI coming in a bit hot on that headline number compared to what we were expecting from a year ago. Taking a look at the Dow, S&P, and NASDAQ all in the red. Flipping over to the bond market, we are seeing a bit of a reversal there just in terms of some of that recent momentum. We're looking at downward pressure now. You've got the 10-year yield off just about 3 basis points. And flipping over to Bitcoin, a trade that doesn't stop. It seems like it's momentum to the upside. Taking a bit of a breather here this morning, though still above 89,000, crossed that 90,000 mark yesterday. Well, coming up, we are taking a look at today's trending tickers and giving you the news behind those moves. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's all with Yahoo Finance's trending tickers page. First up, let's take a look at LVMH announcing plans to make Alexander Arnault, the son of Chairman Bernard Arnault, a deputy CEO of the company's wine and spirits division. This is the latest move in a broad reshuffling of the luxury giant. You're looking at shares of LVMH trading up just about 1% here, 1.5%. But obviously, this is just one of the many changes that are coming as we talk about this generational shift that we certainly are seeing at LVMH. This was mostly, I think, forecasted just in terms of the expectations. He is very young, I believe, just over 30 years old, 32 years old here, executive position here. So again, the fact that he could potentially maybe one day succeed his father at the helm of LVMH, that's one of the things that people are talking about here this morning.
Yeah, good old Bernard, he's 75, so he's got to come up with a succession plan at some point, right? He probably doesn't want to, but does he want to work forever? I always wonder that with these guys. They seem to.
Most of them do.
Most of them really do. It's fascinating. They never want to stop. But I thought it was interesting, too. I can't wait for the Netflix special about this family because all these kids are running different parts of the company. His eldest daughter runs Dior. He's got other siblings running the jewelry and watch divisions. But a question remains about who's going to get the final crown, succession style. And it's interesting to see this particular move because this son that we're talking about, Alexander, is going to be taking on a senior management role outside of the fashion side of the business, which could position him uniquely moving forward as kind of the leader of the siblings. But of course, that remains to be seen. All right, next up, Burberry is going back to basics. The luxury brand's new CEO announcing plans to refocus on its core trench coats and scarves in an effort to win back customers. This comes after the company reporting a loss for the first half of the year and a 20% drop in comparable retail sales for the quarter. So that was a massive drop. He had to do a little bit of a mea culpa here. It's never fun to kind of inherit a company that's having so many challenges. He took over the reins back in July and used his first 90 days to really focus on cost cutting. I think it was to the tune of about 40 million pounds or euros here. And that cost saving initiative leading then to a question about where they're going to focus moving forward. And it sounds like scarves and coats are the key areas.
It does sound like that, and it looks like that is enough for the street here. Just talking about this turnaround plan, it was largely expected just in terms of that we were going to be hearing details of it, but the street very encouraged by what they are hearing, and you're looking at a gain of just about 18% here today. Over the past month, you're looking at gains of just about 31%. Lots of questions just about the luxury market and what exactly demand looks like going forward on a global basis. We talked a lot about the slowdown in China, even the slowdown here in the U.S., just how big of an impact that has had on so many of these worldwide brands. But again, Burberry here laying out his turnaround plan from the CEO, this focus on trench coats, a focus on scarves after the drop that we saw in sales, and that is enough to lift shares to almost 20% here this morning. Let's take a look at Disney. Shares are surging after the company beat on earnings with streaming profits topping expectations. Earlier today, we caught up with the CFO of Disney, Hugh Johnston. Here's what he had to say.
2024 was a terrific year, and Q4 was a great cap to a terrific year. 6% revenue growth, 21% OI, and then, of course, 39% EPS growth. And in terms of the way we thought about the business, we've got two back-to-back billion-dollar movies. We've got terrific things going on with women's college basketball and college football. So certainly feel great about all of that. In addition to that, the streaming service now has turned significantly profitable for 2 quarters in a row. And then, of course, we had a record year in the experiences business. And then last but not least, streaming, we added about 6 million subs over the third quarter. So I think it's a combination of all of those factors and the portfolio working. That fact that we've been investing in those things as well and the fact that we've got sort of good visibility into the future is what has led us to provide forward guidance. And I think the confidence that we have in those investments, whether it's the investments in streaming or the investments in the experiences business, is what's leading investors to basically look at the guidance and say, yeah, this is something that we're really bought into. We feel very positively about it. So certainly the creativity that's coming out of the studios, and then it just sort of plays its way right through the entirety of the Disney company.
Joining us now for a deep dive into Disney's results is Ivan Feinseth. He's Tigress Financial Partners Chief Investment Officer. Ivan, it's great to have you. So we certainly just heard from Hugh Johnston. He was very excited about what we saw from Disney here this past quarter, and I think rightfully so. When you take a look at these numbers, especially the direct-to-consumer side of the business, profit there, $321 million, well above what the street had been looking for. I know you're pretty bullish on Disney right now, so what do you make of these results?
It was a great quarter. I think they're definitely turning a corner. I continue to say that content is king and Disney is the king of content. And the power of their content goes beyond just streaming or even theaters. It goes into the parks. It goes to licensing, product sales. So they get multiple bites at the apple for all of the content that they produce. And they're just great at telling stories and making great content that resonates across all demographics and endures.
It was interesting hearing about their content. Obviously, their movies were big positive over the last quarter, but there was a big question mark about content and the movie side of the business, especially heading out of COVID. Do you think that that question mark is officially behind us?
Absolutely. People are going back to the theaters, especially for action adventure movies of that which Disney dominates with the Marvel franchise and with the Star Wars franchise. And they even do really well in animation. They have had a number of blockbuster animation movies come out post-pandemic, and that drives people to the park. That drives people to buy Disney merchandise and engage in Disney in multiple ways. They're seeing a pickup in gaming. So they're starting to hit on all cylinders, and the company has, I believe, definitely turned a corner. And the profit in streaming is just really a powerful statement.
Is it going to be enough, though, to continue to offset the declines that we're seeing in the linear business?
I believe so. I believe that the creation that Bob Iger did of Disney Plus before the pandemic and turned out to be an incredible move. And I think we're just going to see this move toward direct-to-consumer streaming as consumers can engage in the content they want on the platforms that they want to view it on. And the decline in linear TV, for the most part, has been anticipated for a long time.
It's interesting that you say that it's been anticipated, because it makes me wonder about their outlook over the next 2 and 3 years, which they included, and that was a huge positive from the street's point of view. How do you rate their assessment? Does your math kind of agree with their outlook moving forward here?
For the most part, it does. I believe we will continue to see the growth in streaming. They have multiple platforms addressing multiple audiences. I mean, live sports is also a powerful driver of viewership. They have both the fully paid for subscription model and an advertising paid subscription model, which they're expanding, and more and more companies want to advertise on platforms that they can better target the audience and get a better response and measure of the return on their invested advertising dollar. And Disney helps with that.
Ivan, how are you thinking about the successor discussions, various reports coming out just in terms of who that is going to be, whether it's going to be an executive inside the company, whether or not they're going to tap outside talent? How are you evaluating that just in terms of how critical it is and in who they pick this time around?
Well, I think that Bob Iger has been an incredible CEO. He came back and he's doing an incredible job. And one of the things I believe a good CEO does is to build an enterprise that endures, and whoever takes over will continue to build on the success that he has built.
Would you prefer internal or external for that candidate?
I always prefer companies hire from within. It builds a good culture within the company. So I hope that they do that.
All right, Ivan, thank you so much for joining us this morning. Really appreciate it.
Thank you.
Coming up, we're going to be talking with the CFO of Cisco on the back of the tech company's latest results. A little bit of a mixed picture there, with revenue decline still an issue, but the company beating some street estimates as well. You're also taking a look at the broader indices on your screen here. You've still got the S&P and the NASDAQ in negative territory. We'll be right back.
Shares of Cisco moving to the downside here this morning, off just about 2%. The company reporting earnings for the first quarter of 2025, topping the street's expectations on both the top and bottom lines. But you are looking at a bit of pressure here in the early trading action. A lot of that having to do with the conservative, or at least how the street is viewing conservative annual forecast. For more on this, we want to bring in our guest here for about what's next for the company. We have Scott Herren. He's Cisco's CFO, Chief Financial Officer. Scott, it's great to have you back here on Yahoo Finance. Thanks so much for making the time. So it looks like your numbers for the most recent quarter were very strong. The street, though, focusing on that annual guidance. What's your reaction to the move that we're seeing lower in shares today, maybe what the street is missing?
Yeah, thanks for having me again, Sean. It's always good to see you. And I actually feel really good coming out of the quarter. We were strong on the top line. So we just reported our first fiscal quarter for fiscal year 25. Strength on the top line ahead of expectations at the high end of our guidance range. Strength on the bottom line, 4 pennies above what the consensus and above the high end of our guidance range. We took up our numbers for Q2 relative to what consensus had been, and we raised the guide for the full year. We took up the full year by $200 million and by 8 pennies. So, I'll let the investors decide and the traders decide, what they think about the share price. I'm focused on the things we can control, and I feel really good about the momentum that we've built in the business right now.
Let's talk about that momentum, because it was the fourth quarter of declining revenue. Scott, what's going on there? When is that going to turn around?
Yeah, as you recall, Sean, the last time I was here, we talked about we had a very significant compare quarter. So this was our Q1 of fiscal 25. Q1 of fiscal 24, we cleared a lot of the excess backlog that we had built up during the supply chain constraints, as we couldn't get our hands on components. We built up a significant backlog, and then our team did a great job. Our supply chain team did a great job clearing that backlog very quickly. And we had a very significant, somewhere between $2 and $3 billion worth of excess backlog that shipped in the prior Q1 in the compare point. So that's why you see the negative growth on the top line. When you look at demand, if you look at the order growth, we talked about this on the call, was very strong. Double-digit order growth in enterprise, double-digit order growth in service provider and cloud. We had double-digit order growth in all three of our major geos. So it was pretty broad brush strength across the board and across our product lines.
Scott, you mentioned the growth in orders now coming back online, and I think it's a big question here for investors, for analysts, as we head into 2025. I'm curious what you've seen even within just the last week. Now that we're post-election, we have some clarity within the White House. Are you starting to see a more willingness to spend from some of your clients?
Well, again, I don't want to comment on the current quarter that we're in, but, our expectations as we look ahead is based on the strength we saw across products and across geos, we'll continue to see that. That's what was embedded in our guide for we're in our second fiscal quarter right now. It's hard to predict, what's going to happen from a political standpoint, but when you look at the things that are going to drive government efficiency, right? We've got this Department of Government Efficiency now. That's about increasing productivity, and technology is always going to be critical to increasing productivity.
So is this good news then for tech, and more specifically your business?
We certainly see strength across the board. Again, I don't want to comment on the things that we don't yet know on how that's going to play out, but we see strength across the board, and it's really on the back of a portfolio refresh that we've done over the last couple of years. Great execution inside the sales team through the quarter that we just closed, and a view of AI really beginning to ramp. And our play in AI is actually quite strong. One of the data points we gave on the call last night is we saw more than $300 million in orders, AI-specific, AI infrastructure orders during the first quarter, during the first 90 days of this year. And that puts us on a nice track toward the $1 billion, more than $1 billion worth of AI orders that we expect for this fiscal year.
Yeah, I'm curious too, just to stick on the impact of the incoming administration for a second, and then we'll get to some of the AI goodness. When do you expect to be able to get some clarity on some of the delayed deals that you all have had with government agencies? And do you think that an incoming administration could fast track that so that when you're dealing with the balance sheet, you can officially kind of put that revenue on the bottom line?
Yeah, again, I'm not a political analyst, but the fact that we've got now, I think, Republicans controlling both sides of Congress, and we've got a Republican White House, should ease the process of getting to a budget, which will then obviously get us through the continuing resolutions and the Fiscal Responsibility Act. That was really a bit of a crimp on our U.S. Fed business during the first quarter.
All right, let's get to the AI goodness here. I know that some of your hardware has NVIDIA GPUs. They're the most effective, but as you know, Scott, they're really expensive. Are you looking to change that at all? Would you consider switching to AWS chips that are a little bit more affordable? Have you had those conversations in budget meetings?
You know, as we look at the build out of AI infrastructure, and now what we're talking about is less on the web scaler side, on the hyperscaler side, and more about how enterprises are going to build out their own inferencing infrastructure. We'll work with whoever our customers want us to work with. They want us to work with NVIDIA. We just launched our AI pods, right? Which think of that as inferencing in a box that you can just put in. It's got our UCS servers with NVIDIA GPUs on it. It's got our backplane control, and it's got our top of rack switch. That just launched, and that's based on customer pull. To the extent that customers want us to work with others in the GPU space, that's something we'll take a hard look at.
So Scott, you're a financial guy. You're the perfect person to talk about when it comes to cost cutting. Obviously, the efforts that you laid out just a few months ago. Do you have plans? Are you comfortable with some of the moves that you have made, or do you see a need to tighten your budget at all as you look ahead to 2025?
Yeah, I think one of the bright spots from last night, Shauna, was the strength that we had in our gross margin line, which then fell through to being above range on operating margins as well. There was some one-time benefits in the first quarter, but we see for the full year, our gross margins now about a point higher than we saw just 90 days ago. So I think the work that we've done and the great discipline that we're known for, financial discipline that we're known for, is paying off, and that's one of the reasons that you saw us take up the full year guide. We're 90 days into the year, right? And we just increased our full year guide by 8 pennies on the bottom line. I think we're in pretty good shape there.
All right, Scott, thank you so much for joining us on the heels of that earnings call. We really appreciate it. Scott Herren, Cisco's CFO. Thank you. We'll have all your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts. Bitcoin rally losing just a bit of steam this morning after a big run to the upside, topping 90,000, now hovering around 88,000. Joining us now to discuss what's driving the moves, we've got Johan Kerbrat. He is the Vice President and General Manager of Robinhood Crypto. He is joining us with more on the company's crypto offerings and this rally. So, John, it's great to have you in studio. Thank you for coming in. We're seeing a little bit of losing steam today, I guess, right? A brief topping of 93,000, coming off of that a little bit. What do you attribute this to? Is this something that you think crypto folks need to be concerned about?
Well, I think it was a pretty big rally since the election of last week, so I think it's normal to see a bit of volatility and seeing a bit of a pullback.
How are you looking at the enthusiasm surrounding the crypto market just more broadly? Is it enthusiasm that makes sense to you? Do you think, to borrow one of Maddie's phrases, are investors a little bit over their skis just in terms of what they are anticipating and maybe what is more likely to be a reality?
Well, I think the market speaks for itself. Since the election, we've seen a lot of enthusiasm, and the rally is very, very important. I think it was a big news that we'll have a more crypto-friendly administration next year and more regulation that are helpful for the industry. And I think people are enthusiastic about it and they want to contribute.
And for investors who see a dip like today's, which to your point, it's like very small given the context of the extent of the rally, but where should investors be looking to effectively deploy capital in the space? Is Bitcoin the safest move for folks, or should they be looking more seriously at some of these altcoins that we've also seen rallying?
I think Bitcoin is really one of the main reserve at this point of cryptocurrencies, and but at some point we also have to think about diversification. So it's important to look at other currencies and trying to understand what they do, what they offer, and how to invest in them.
So you're out with some news this week, expanding your crypto offerings, Solana, Pepe, XRP, among the new offerings that you are coming out with. I'm curious just in terms of the timing of it, right? Just because now we are post-election, we're seeing more and more interest within crypto. How are you then working that into the offerings within your platform and where you're seeing those opportunities?
Yeah, so we have a constant feedback loop coming from our customers. They are asking for the offer that they want to see on the platform. We're always looking at it. And we also have a very strong listing committee that look at many aspects of every currency that we put on the platform. And before deciding on listing these assets, we want to make sure that we can offer it safely on the platform and that there is no major issues. And when we saw the enthusiasm last week, we wanted to meet the customer demand, so we added these 4 currencies on the platform.
Talk to me a little bit more about that decision, because, and I'm not a crypto expert admittedly, but how do you suss out that Pepe is really going to have staying power?
Well, I think for us, the goal that we see ourselves is to give access to what the customers are really asking for and to be able to offer it safely for them. So we want them to be able to deposit or withdraw the currency from the platform safely. So we are looking at many, many aspects. At the end of the day, we think that some of these meme coins that you mentioned are, interesting also for an introduction into crypto. A lot of people have been able to use them to send to their friends because there is not a ton of gas fee or network fee, and it's a bit of a fun currency for them.
What are you seeing, and I know these products are new, but just in terms of the crypto offerings that you already have, what are you seeing just in terms of the uptick in interest?
We definitely saw, last week has been a very important, increase in volume and interest. We see also not just on our platform, but on chain. We see people buying on Robinhood and then on-ramping into their self-custody wallet or other platform, and then they do more things on chain. So we definitely see a lot of enthusiasm right now.
Is that good or bad for you guys? Do you want people on platform as much as possible?
Well, I think, for us, we have the whole offering. We have our own self-custody wallet. It's called Robinhood Wallet. And, as long as customers are using one of our platform, it's very good for them and for us in the sense that we know that they use a product that we have spent time building. And I think at the end of the day, crypto is moving so quickly, we won't be able to offer everything that crypto has to offer. So having the wallet is an option for them to be able to access this world.
Since you are the crypto expert, how do you evaluate just where we stand within the crypto community, within the crypto enthusiasm? Because it's such a headline-driven market. And we certainly have seen this euphoria sweep. And we've seen this happen before, maybe not to this extent or just the current levels that we're seeing, but we have seen this kind of up and down volatility surrounding Bitcoin. How do you then factor that into some of these offerings, and what makes the most sense then for Robinhood?
Yeah, so for us, we have 19 assets on the platform, so we are a fairly limited shop in terms of offering. But if you look at the past few years, for Bitcoin, for example, we've seen this constant growth, and we've seen in January and February that there is also institution coming in through the ETF. We're starting to see a lot more institution coming in now, also because there's a bit more clarity coming in next year. And so, we want to make sure that we offer what the customers are looking for.
All right. Well, Johan, it was great having you on set here with us today. Johan Kerbrad, he is the Vice President at Robinhood Crypto. Thanks so much.
Thank you.
The U.S. Justice Department is investigating Polymarket for allegedly accepting trades from U.S.-based users. This is according to a person familiar with the matter speaking to Bloomberg. Now, the FBI executed a search warrant on the CEO of the crypto predictions betting platform, seizing his phone and his electronics. That's according to the report here from Bloomberg. Now, the raid coming after massive trades in the final days before the election by a French whale in Trump's favor, which brought additional scrutiny of the platform. We talked a lot about that one French trader reportedly here winning nearly $50 million. The company reportedly had been raising new venture capital, having already secured over $80 million from backers, including the likes of Peter Thiel's Founders Fund. Of course, this is just reports, early reporting here of this raid. Exactly why and what caused it doesn't seem to be immediately clear. There's lots of talk about what warranted this type of search, why it was done the way it was done. But again, there certainly has been, you and I talked a lot about the Polymarket predictions and how exactly that played in to the presidency, to the presidential election this time around. And I think the focus here coming on the heels of the fact that they did get it right, the fact that Trump was expected to win, and to that degree, and the fact that it kind of went against most of the polls out there has, of course, brought regulators and some officials just in terms of laser focus then on Polymarket.
Yeah, and it makes a lot of sense that there are still a lot of questions here, because I think one of the things that was a question even when betting on elections became legal was this idea of how do you track insider trading on a platform like that? If you're someone who works on a campaign and is close to a candidate, should you be allowed to trade? I think there are still a lot of questions about that moving forward. We don't know what exactly inspired the raid. We do know, though, the founder of Polymarket is back on X somehow, either himself or through proxy. Again, I don't know, but he posted new phone who dis yesterday. And then today he posted a longer thing about how it was discouraging that the current administration, in his view, went after companies that seem to be associated with political opponents, but they are committed to being nonpartisan. And the company in general, with their statements over the past couple of days here, throwing cold water on this idea that there was, any malpractice here, and saying that this seems like a reaction to Polymarket knowing something that the pollsters didn't, which again continues to be a question, even given the fact that we know that there were a couple of really big whales who were placing these bets. So we don't know how kind of democratized the access was to these betting platforms in the first place.
Yeah, certainly we will continue to follow this story as we do get more details. Keep it right here on Yahoo Finance. We got much more coming up. Stay tuned. You're watching Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack. Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
President-elect Donald Trump announcing that billionaire Elon Musk will lead a new Department of Government Efficiency alongside Vivek Ramaswamy. Musk has not announced plans to step down from his roles as head of Tesla, X, or SpaceX while performing those government duties. So what sort of corporate governance issues could arise here? Joining us now to discuss that and more, we've got Charles Elson. He is the founding director of the Weinberg Center for Corporate Governance. Charles, it's great to speak with you. I know that you have your own history of critiques on Elon Musk, which we're going to get to in the conversation, but I just want to start with your thoughts, your takeaways, and your response to this new role for Elon.
Well, it's a big role, obviously. You're not talking about advising on a little something or another. This is reforming the entire United States government, which is, it's a big job. Obviously, President-elect Trump has great confidence in him and his abilities to look at the government from a business perspective and suggest some changes. So it's going to be a lot of work. It's not, hello, here I am, goodbye. It's going to be, if he does it right, and he's got a co-chair as well, it's going to take a lot of time. And I think that's the issue. I mean, how can you run Twitter, X, SpaceX, and this? And that's the problem. Jack of all trades, master of none. And that's the governance issue here. Now, obviously, the other companies aren't public, though. Obviously, X has some some debt that the banks involved. But on the other hand, Tesla's a public company, and people, paid him a lot of money, or he's seeking, in this case in Delaware, as you know, quite a bit of money. How can you do both?
Well, what about the legality of all this, just in terms of the risks that then could potentially pose here to shareholders of Tesla?
Well, the problem is he has a fiduciary duty to the investors of Tesla as a director, and obviously as a CEO of the company, and which means his time needs to be spent there. And something that makes it impossible or very difficult for him to carry out those responsibilities would suggest either he has to leave Tesla or turn down the government job. I don't think he's going to turn down the government job, and I don't think he's going to leave Tesla. But of course, this is something up to his board to decide. Though this is, as you remember from call from the case in Delaware, the board hasn't been viewed, at least by the Delaware judiciary, as particularly independent of him. And would they say anything? The mere fact that he took such a big role in the campaign and combined politics, in his business, if you will, is highly unusual too. And the board didn't object then, and I would imagine they're not going to object now. Basically, he seems to get what he desires, because if he says, if I leave, the whole thing comes apart. I doubt that, and I don't think you can base a business around one person like that, but here we are.
Here we are, and it's interesting because it sounds like, Charles, you're echoing this idea that we've heard from other guests too, that there's a lot of shoulds, right? Should Musk be running all of these companies and having a role in the government? That's not really for me to decide, but in a Trump world, I don't know that it matters.
He's going to do what he's going to do.
Yeah.
And look, if this is not congressional, if he's not subject to any kind of congressional approval for the job, if it's simply an advisor, then who knows what happens next. Remember, Carl Icahn was an advisor to Trump in the last administration, and last time he was president, and there was no congressional approval. It was an advisory role. And it seems as though this is probably pretty much the same thing. I don't think Mr. Musk would want to go through congressional approval for a lot of reasons.
Charles, do you think companies should, maybe some of them do, just establish more guidelines in terms of political affiliations, what can and cannot be done? Obviously, Tesla might be a little bit different, just given the fact that Elon Musk was the founder and the fact that he is so ingrained and intertwined within the company. But just in terms of this situation happening again, I guess, how should boards be thinking about this?
Well, look, it's part of your civic duty. If the President of the United States asks you to participate on a commission or something like that, it's part of your civic duty, or an advisory group on business or in trade. A lot of people do that, and that's probably expected in the job as CEO. This is different, though, because this is almost a full-time, or maybe more than full-time, 120%, given the task ahead of them to do. And at that point, a board should say, if you can't devote sufficient time to us, then you've got to leave the job. And I think that And frankly, but there's nothing wrong with leaving. Listen, you remember the former head of Exxon was Secretary of State. He left Exxon to become Secretary of State. He couldn't have done both. You have a conflict of interest there, too, because Musk, as you know, has government contracts. There's government regulation of the car company and the space company and whatnot, and obviously government involvement with X. And you've got a potential conflict of interest. Just by running these companies, and being in the government at the same time, do the companies get benefits from his service directly to the companies themselves? That's a problem too. It's conflict of interest. That's why typically you become a cabinet secretary or something like that. You stop your other business and you focus on this.
Well, Charles, how would it not, though, right? You have someone that's closely advising the president. He's going to be, you would think, as I think naturally people would, just in terms of pushing policies that are in his own best interest, and I'm sure he views it as in the country and the world's best interest as well. But it's almost impossible for it not to benefit his own companies.
That would be true. That's typically why, in most companies, where someone leaves a company, goes to government service, they put their stock in a blind trust and they sever all ties so that you won't have that issue. But again, if it depends on what he's doing. If he is simply an advisor who's sharing this commission, that's it and has no direct authority over government contracting and whatnot, that's a grayer area. It's not a good idea. Frankly, the best way would have been to completely sever his ties to those businesses and take this job. But he was never going to do that. And obviously, the president-elect values his advice. He has created, or he has put it this way, disturbed more norms than any single business type I think I've ever run into. But and at some point norms do come back, and I think it's sad here they don't.
Charles, I just want to end in our final minute on Musk's pay package, which you have been a staunch critic of, and it impacted your own career previously. How do you think his pay package could be impacted by this? I mean, I have a lot of questions. He's going to get paid by the government. Like, what are your thoughts on his pay moving forward?
I would doubt that he'd be paid by the government on something like this. He'd be $1 a year person. I mean, he's got so much wealth that you can't compensate effectively. Now, on the Tesla question is, does this impact the judge's rule? I don't think so. She's going to make it in this month, I would suppose, or early next month, and we'll find out if she decides that the shareholder vote was invalid in ratifying the package. Now, then the question is, will the Tesla board come back and give it to him something like this again? Particularly if he's not there. So that's a tough one. But that's the key to the board. That's why you want an independent board who has equity in the company, who works for the interests of the company rather than a relationship they may have with the person running the company. That's the sticky wicket in this particular case. And you've just had a new sort of a bomb thrown into a very sticky wicket. And, it's one of these, who knows how it turns out. But it is entertaining, that's for sure, for those of us kind of on the outside.
It certainly is entertaining. Charles Elson, thanks so much for taking the time to join us here this morning. That does it for Catalyst. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking about Wall Street's outlook on 2025. One strategist says that we can expect to see broader opportunities in stocks over the next year. We'll dig in. And Bitcoin trading near all-time highs. We're going to talk to an attorney about strategies that you can deploy to minimize your taxes on the cryptocurrency. Plus, FAFSA rollout for the 2025-2026 school year starts December 1st. We'll break down the changes to the process and tell you how you or your children can prepare. All that and much more during today's hour. But first, we take a look at some of the market action. 90 minutes into the trading day. Stocks right now edging lower just a little bit after October's producer price index, PPI, came in slightly hotter than expected. Joining me now, we've got Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist. Great to have you here with us back on the show, Veronica. So what does this mean, this data, for the Fed's next move in your view?
Yeah, I think this latest inflation data just reinforces that the Fed is still going to be able to cut rates. But thinking about next year, they'll probably think about slowing that pace of cuts. Getting inflation down to 2%, just these last few basis points is going to be a difficult job, and the Fed's not going to want to get ahead of itself by cutting rates too aggressively.
So slowing the pace of cuts next year, what does that really hold for the strategy that investors would be apt to consider and think about even ahead of 2025?
Yeah, thinking about 2025 in the fixed income space in particular, we're liking the intermediate portion of the curve. We think that there are, those reinvestment risks with short term, especially as the Fed is still cutting rates. And then even with the long-term rates, take advantage of these upticks in rates to lock in that higher yield, but don't overextend yourself in the longer-term portion of the curve. That intermediate seems to be the sweet spot right now.
And so that was the fixed income analysis. What about within the equities? How would you be looking across some of the sectors, and where are you kind of anticipating that there could be perhaps some differing performances that we might see play out?
Yeah, in the equity space overall, we still like large caps the most, but we also like mid and small. We're kind of neutral with our guidance on mids and small caps, but favorable on large caps. And thinking about the sectors, you talked a little bit earlier about that broadening performance. We like communication services, financials, industrials, and energy. So we're thinking a little bit outside of just that tech box, because we think that some of those sectors are going to perform really well in 2025.
And is it earnings growth? Is it just rebound? Like, what specifically within those sectors do you think really plays into them being the most biggest beneficiaries rather, as we are looking out into 2025?
Yeah, so it's really a cyclical play. We think those sectors are going to do well as economic growth improves in 2025. In the tech sector in particular, those valuations are not as attractive because of that run-up we saw earlier in the year. So you've got a little bit more attractive valuations for some of these other sectors, but they should also benefit from improved growth in 2025. And they'll also be beneficiaries of that AI trade. It's not just a tech story. I think some of these other sectors will also benefit.
With the AI trade, since you mentioned it, a lot of us are trying to figure out, and a lot of investors out there that have been watching even some of the new calls in specific names and the poster children of NVIDIA that have come out this morning, how long and what type of legs the AI trade still has to it. What would you be looking towards to really govern or guide that thesis at this juncture?
I think we've got a long way to go before the benefits of AI are fully felt throughout the economy and throughout all of these companies. And so it's a long-term theme that can continue to play out. There's going to be volatility in the near term around different regulations as they come on, and maybe as, companies emerge as leaders in the space and maybe other companies pull back. So I think it's important to look past that near-term volatility and think about how those themes can play out over the long term. And energy and industrials and other parts of the financials sector will benefit from, generating AI and using AI, and not only those companies in the tech sector.
Veronica, while we have you, 2 questions just while we still have some time here. One, and the first one that we'll tackle is, as we're talking about 2025, there's also, of course, going to be some significant changes in Washington, D.C., which could mean some significant changes in policy in 2025 as well. If there is one policy or maybe a handful that you see really driving the delta between the returns that we've already seen and the performance that we've already seen here in 2024 and what could play out, what would those policies be and what should investors be keeping close eyes on?
Yeah, I think I'll kind of tackle what the investors should be watching. The potential impact of some policies, in particular, additional tariffs having an inflationary impact on the economy. And so we've seen the market kind of pricing in the benefits that small caps and even large cap companies might have through 2025. But I don't think the market is pricing in that potential for inflation to pick up in 2025. We are expecting inflation to be a little bit sticky through 2025. So I think that's a bit of a market risk right now.
And then just lastly, does what you've kind of baked into your outlook at this juncture mean that we avoid a hard landing and that we see a full soft landing, or just, hey, maybe there's no landing. Maybe we're just tired of this airplane analogy?
We are expecting a soft landing. So, we think over the next couple of quarters, economic growth is probably not going to be as robust as we've seen in the past several quarters. But then looking out further into 2025, we're expecting that growth to pick up again. So kind of a short but soft landing.
All right, Veronica Willis, who's the Wells Fargo Investment Institute Global Investment Strategist. Veronica, always a pleasure to get some time and insights with you. Appreciate it.
Thank you.
The Labor Department reporting that the number of Americans filing for first-time unemployment fell to its lowest level in 6 months. Joining us now to break down the numbers, we've got Catalyst co-host Madison Mills. Hey, Maddie.
Hey, Brad. So like you said, the lowest number in 6 months since May. The 4-week moving average for jobless claims also coming bang in line with expectations. And we've been talking a lot about the impact of those extreme weather events in the South. We're kind of getting to the end of when we expect to see the impact of that in the headline numbers here. So that kind of huge change to initial jobless claims to the upside that we were expecting on the heels of those extreme weather events, it's kind of not bearing out the way that we expected. Obviously, we saw it in the NFPs, the non-farm payrolls print, but it's sort of been priced in at this point. So it's not looking like this huge crash in the labor market that some were talking about. Greg Dacco earlier this morning saying the labor market is cooling gently, but there's no evidence of a layoffs wave. And when it comes to the inflation question in the room, there's this idea that maybe you could put a little bit of pressure on the labor market so that inflation comes down. It's seeming more and more like this idea that Neil Kashkari talked about at Yahoo Finance Invest is true, that the issue with inflation is on the supply side, not on the labor side. And to that end, we got the producer price index this morning and core PPI rising a little bit month over month, but that was expected. There is a question, though, about some of the data under the hood and whether or not that could lead to more inflation when we get that PCE, that PCE data in later this month, which is the Fed's preferred measure of inflation. Could that tick up, and what could that mean for the Fed's fight against inflation moving forward?
We also recently got some data from the National Association of Realtors about the housing market and some unprecedented changes to who is buying the majority of homes. So what can you tell us about that?
I think this is such an underpriced issue when it comes to inflation. The idea that people who are our age, Brad, we're not buying homes. We know we're not going to be able to afford it. So then we're not having to save as much money.
Keep hope alive.
I've totally lost hope for myself. So I'll take some of your optimism. But basically this idea that we're spending more on stuff because we're not going to be able to buy a home. And we know that just 24% of home buyers are currently first-time home buyers. That is the lowest since they started collecting that data. We also know, I want to pull up the chart here if we have it, this percentage has more than halved since 2010, according to the National Association of Realtors here. And you can see here the median average age of home buyers really ticking up since they started tracking this data 40 years ago. All of those lines going up to the right here, both first-time home buyers and repeat buyers here. And this is also pushing up rents for those of us who are not home buying because there's more competition in the space since people aren't buying homes. So Sorry, guys.
There's a much longer discussion drawn out about some of the causes that are going into what we're seeing play out as well. We will leave that for another. Actually, we'll just continue to have it as we go on throughout wealth. Quite frankly,
Right.
I'll infuse it one way or another. Thank you so much for joining us here, Maddie. Appreciate it. Now, time for some of today's trending tickers here. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Our big ticker today, though, let's go to the House of Mouse, Disney, which reported an earnings beat in the fourth quarter in the company's direct-to-consumer business, building on recent momentum and swinging to a profit. Yahoo Finance senior reporter Alexandra Canal has more. Hey, Ali.
Hey, Brad. Yeah, a really strong quarter here for Disney, and you're seeing that reflected in the price action today. We're seeing shares up just around 8% on the heels of this report, but the earnings call just wrapped up, so I want to focus on three things we learned on the call. First up, M&A. This is something a lot of competitors have actively been discussing, especially with the incoming Trump administration. Warner Brothers Discovery included in that bucket, along with Comcast, which actually explicitly said it's exploring spinning off its cable unit. But Disney, they said it's not the case for their own business. Take a listen to what CEO Bob Iger had to say.
We, in many respects, have already consolidated. We don't really need more assets right now, either from a distribution or from a content perspective, to thrive in basically a disrupted media world.
So not interested in any acquisitions or divestitures at this point. Bob Iger has, of course, flip-flopped on this in the past, so anything is possible for the future. But for now, a clear signal to the market that Disney and its assets are not up for sale. Number two, let's get to the parks business and consumer demand. Now, we did see that as a big issue when Disney last reported earnings in August. We saw domestic operating income at the parks falling year over year, but that wasn't the case this time around. Domestic OI increased 5%. We did see some pressure internationally, down 32% amid the Paris Olympics, along with a typhoon in Shanghai. But the company believes that overall demand will tick higher in 2025, especially in the back half of the year. Here's what CFO Hugh Johnston said on the call.
In domestic, we certainly feel like the consumer is strengthening. We saw some consumer softness in Shanghai. Candidly, we expect that to be temporary, and we expect that to bounce back as well.
The parks are an incredibly important component of Disney's business, so investors are always hyper aware of how the demand side is looking, but so far seems to be so good. And then finally, number three, let's get to ESPN, that flagship launch coming next year. And Bob Iger, he couldn't be more bullish. He said it's ESPN, quote, like it has never appeared before for the consumer. The company is going to lean heavily on technology and artificial intelligence. Betting will also be integrated into the platform. He said that with technology, almost anything is possible there. So that fully over-the-top streaming offering is going to be something that the company thinks will be a tailwind that could potentially boost earnings and hopefully capture that consumer.
I can't wait to see what they mean when they're talking about artificial intelligence at ESPN.
He said, think an AI-driven sports center, how you can sort of take the consumer into the room, into the studio, onto the court. So it seems like they're willing to experiment with a lot of different things, but it'll be interesting once this launches what it's actually like.
Yeah. All right. Ali, thanks so much. Appreciate it. All right, guys, coming up on the other side of this short break, Bitcoin is trading lower today, but has been popping since Trump's ballot box victory. With more activity around the token, we want to help you understand strategies that you can use to maximize your taxes, minimize your taxes, and maximize your gains on cryptocurrency. Stay tuned. Bitcoin falling today, but it's up more than 30% in the past month. Many of those gains attributable directly to President-elect Donald Trump's victory at the ballot box, as you can see some of the price action there on the chart. With more people interested in holding crypto or adding to their positions, we're bringing in an expert to discuss the tax side of your investment. Joining me now, we've got Andrew Gordon, partner, tax attorney, and CPA at Gordon Law. Andrew, always a pleasure to grab some time with you and get some insights here. All right, so for those who have seen gains in their crypto, especially in the closing weeks of the year, what does this mean for their taxes come 2025?
Well, for those of you that are holding Bitcoin, you've almost certainly seen gains already, although we've seen a slight drop today. This week, we've been at all-time highs and even seen some of the largest single-day growths. But if you're holding crypto, one of the good pieces of news is that you're only taxed when you sell or exchange. Bitcoin is taxed much the same as stocks or other property. So when you sell, dispose of it either for cash or even for other cryptocurrencies, that's a taxable event. But there are ways that you can minimize that tax. And one of the best ways before the year end is to harvest losses from other tokens or other property. So although your Bitcoin sales may be at all-time highs, if you have other property or stocks that are at losses, now may be a great time to harvest those losses to use against those Bitcoin gains. Another great strategy is to hold for long term. Crypto is taxed just like stocks with short and long-term gains. So if you can hold for longer than a year, you can greatly reduce your taxes.
And so what is that tax rate? And ultimately, how should people look at their holdings and say, or apply a general kind of rule of thumb to say, okay, if I have not exceeded this percentage in gains, then I probably shouldn't be looking to sell right now, because if I have to pay taxes on that, then that's going to wipe out much of the gains.
Yeah, and you're spot on, Brad. As your gains increase, typically your tax rate also increases as well. And with cryptocurrency, just like other stocks, you're taxed on the gain. So the difference between the original purchase price and your later sales price. With crypto, there's short-term and long-term, and your short-term is taxed at your ordinary tax rate. And your ordinary tax rate increases as your income or gains increase. So one of the things that you might want to do before year end or before executing on a sale or trade is to consider if it's going to push you into a higher tax bracket. Because if it does, it might make sense to wait till the next year.
When we think about the taxation of Bitcoin and what has been the definition of the IRS's kind of classification of crypto as property, how should people also be thinking about future purchases that they want to make in crypto and the percentage of crypto that really kind of makes up their overall portfolio of investments?
Yes, so you should make your own investment decisions as far as how much crypto to hold relative to other investments. But what we're seeing is that Bitcoin and cryptocurrency is being treated more seriously than ever before, especially with the incoming Trump administration. A lot of people believe that there may even be a Bitcoin reserve. So now might be a great time to consider investing in Bitcoin if you haven't before. We're expecting to see a loosening of regulations and hopefully greater clarity on how the crypto industry is to run. And with that, hopefully price increases will follow.
Do you think that the establishment of a Bitcoin reserve, or at least a larger, more formalized holding, because the U.S. actually owns, compared to other countries, already owns the most Bitcoin when compared to other countries around the globe. I think it's something in excess of or north of 200,000 Bitcoin versus the next closest country in China that has about 190,000 at this juncture. So all these things considered, do we expect the establishment of a reserve to then ultimately change the way that crypto is taxed if we do see the administration prioritize this?
Well, I hope that it will bring a new focus to many of the tax issues that have been occurring in crypto. One of the distinguishing points between crypto and stocks is that crypto investors need to report by themselves on their own. There's no 1099-Bs filed, and if you don't do it right, you can have severe penalties. Hopefully with the establishment of a Bitcoin reserve, the federal government holding Bitcoin on their balance sheet, there will now be a need for greater regulations, greater clarity, And with that, adoption will also follow. So hopefully it will be a good thing.
Just lastly here, Andrew, and we only got about 30 seconds. What if you have a small business and you decide to put your crypto holdings on your small business's balance sheet? Is there any major difference there between how you're filing on that kind of tax entity?
Yeah, that's a great question, Brad. And one of the things that catches a lot of people off guard is now on your tax return, there's a yes or no question, even for businesses, if you have crypto activity. It's that important for the IRS to know. So the biggest thing is making sure that you answer that question correctly, but also have a tax professional that understands crypto, because it is held and treated a lot different than things like currency or US dollars.
Andrew Gordon, who's the partner, tax attorney, and CPA at Gordon Law. Andrew, always a pleasure to grab some time. Thanks so much.
Thank you, Brad.
Certainly. More American households have access to bank accounts than ever before. This is according to a new report from the FDIC. Yahoo Finance's David Hollerith joins me now with a closer look at this data. Hey, David, good to see you.
Hey, Brad. So 96% of U.S. households are banked, which means that they have at least one bank or credit union account. And that's up from 300,000 households, up by 300,000 households from 2021. And it's also the highest rate on record, according to this closely followed survey from the FDIC. Now, U.S. officials, particularly the Treasury Secretary Janet Yellen, have argued that more banking access, especially more access to affordable credit, enables a stronger economy and a more fair economy. Bank accounts, after all, are sort of the first way that consumers can build credit. And if you follow that line of thinking, there's also still more work to do. Per the survey, it found that there are about 5.6 million households, or 1 in 25, who are still unbanked, meaning they don't have access to these kinds of services. Unbanked rates among Black, Hispanic, American Indian, Alaska Native households are also still several times higher than white households. Unbanked rates are also higher, have remained higher among households with lower income, less education, those of working age with a disability, and also single parent homes.
David, any other big trends that jumped out to you from this data?
Yeah, the report is huge. Just a few other trends that really stood out. The survey found that non-bank online payment services increased from the previous survey. And it continues to correlate with banked households, meaning that people who use payment applications, fintech, even crypto, tend to be banked. And also, the survey found that for the unbanked population, it does appear that this comes down to a lack of trust in banks. 71% of unbanked households said they aren't interested in becoming banked. And the second most cited reason for why is that they don't trust banks. The FDIC also polled survey respondents on crypto, and this was a new part of the questionnaire. And the survey found that 4.8% of U.S. household respondents do own cryptocurrency, and the majority of them cite that they do for investment purposes. About 4.4% say they use crypto for purchases.
David, thanks so much for taking the time to break down some of the findings here. Some really remarkable steps, but still a lot of work to be done to make sure that the households that would like to be banked have access and tools to their use as well. David, appreciate it. Thanks.
Absolutely.
Coming up, everyone, your Yahoo Finance Market Update with our very own Akiko Fujita. She'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day, and it is time for Yahoo Finance's market update. Stocks stalling out here, post-election momentum losing steam a bit as we see the Dow, S&P 500, NASDAQ trading pretty flat here. Headlines you need to know at this hour. The dollar marching higher, continuing its gains fueled by the election. The greenback hit a one-year high against major currencies and is now on track for a fifth straight day of gains. The dollar climbing above the Japanese yen, 156 here for the first time since July. The euro falling to its lowest level since November of 2023. Shares of Intuitive Machines seeing a big reversal in this session. That stock now down more than 5% after hitting a 52-week high on strong results. Revenue for the space exploration company more than tripled in the third quarter, year on year. The company also reported record backlog thanks to its fourth contract under NASA's Commercial Lunar Payload Service program. And shares of Norfolk Southern here down just over 1.5% after the company averted a proxy fight with activist investor Ankara. The two sides struck a deal to add a new board of directors, while Ankara agreed to withdraw its nomination of 4 director candidates at Norfolk's upcoming shareholder meeting. Ankara escalated its fight after former CEO Alan Shaw was fired following an inappropriate relationship with the company's chief legal officer. The firm released a statement today saying it is a new day at Norfolk Southern. And that is your Yahoo Finance market update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
The Consumer Financial Protection Bureau found in its 2023-2024 student loan borrower survey that 63% of borrowers reported difficulty making loan payments. One way for students to find federal grants, scholarships, and even work-study funds is free application for federal student aid, or FAFSA. The FAFSA form for the 2025-2026 school year opens on December 1st. I want to bring in Mike Ramirez, who is the EP Wealth Advisors Associate Director of Financial Planning and Certified College Financial Consultant, to break down what you need to know. Okay, so December 1st, I mean, it's not the time to just immediately then say, okay, now let's do the research. What is the prep work that needs to be done going into December 1st for any families, any individual students that are looking to apply?
Yeah, sure. Yeah, thank you for having me. You're absolutely right. I think we're about 17 days away, if I did my math right, from December 1st. And you're right. Right now is the correct time to prepare. There are things that families can do today in order to log in to studentaid.gov and be ready to go come the 1st. Namely, just creating your FSA ID. If you go to studentaid.gov, you are required to have a password and login information. Get that out of the way so you're not scrambling to do it the day of. We have had reports in previous years that it does take a couple of days to confirm through the website. So to get it done sooner rather than later, and so you're not scrambling once that window does open. Also, get your documents together. The FAFSA is going to ask for things like your tax return, like your social security numbers. You're going to have to know, the balances of your checking accounts, of your brokerage accounts. To have all your financial information in front of you so you're ready to report it is going to help you out tons, so you're not scrambling.
What are some of the biggest changes in the not just filing process, but the disbursement process as well? As we've heard that there were issues last year with FAFSA getting through so many of the applications and making sure that they also were dispersing funds on time.
Yeah, last year we did experience a lot of issues, unfortunately. This year is similar to last year. The FAFSA form 2 years ago was around 108 questions. Now that's asking a lot of families. The FAFSA is now reduced to about 36 questions. It is a dynamic application, so depending on your financial situation, you may see a bit more, you may see a bit less. So the application itself is simplified. Another big change is that there is a term that typically what the FAFSA, what you're filling out is to get to a number. That number originally was called the expected family contribution, or EFC for short. The Department of Education is no longer using that term. We're now calling it the Student Aid Index. There's been slight changes, but more or less it's the same figure. It's just determining what a family can afford to pay for 1 year of school.
And additionally here, as we think about some of the changes that are going to take place, not just to filing this year for next year, but also once we get into a new administration in the White House, it feels like things are going to change drastically with education based upon some of the campaign rhetoric that we heard. What does that hold for the future of FAFSA as well, from what we can estimate?
That is the $1 million question, isn't it? President-elect Trump did run on kind of a radical idea of eliminating the Department of Education. Now, can he do that? Technically, yes. It is going to take about 60 votes in Congress to get that passed. Will he do it? My guess is no. If you do close the Department of Education, it's going to wreak havoc across the country. And the folks that are going to feel the most pain are low-income households, special needs, or families who have students with special needs. My intuition is telling me that probably won't happen, but Department of Education is really not has not done anyone a good service the past couple of years. They have kind of dropped the ball. So there is a lot to digest. We're kind of waiting to see what President-elect Trump does propose, and with a Republican majority House, to see what they can accomplish.
And it sounds like some of the issues over the past few years have been with staffing, with having the necessary amount of employed people to work and get through so many of the applications so there's not such a backlog, so that students don't feel like they aren't getting the service that they are coming to expect when they do submit any type of application. But it doesn't sound like that's going to be rectified. So what does this mean for some of the even student loan forgiveness that's already been applied for?
Right. So the government contracts through loan servicers. The loan servicers have been really hard to deal with. They are understaffed. When our clients have questions and we need to make a call to one of the loan servicers, the wait time has been, I've seen it as high as 8 hours. Now, no one's going to wait on the phone for 8 hours to get a question answered. There's been a lot of slow follow through, slow responses to emails, or no responses at all. It is a big pain point, and honestly, I don't see a solution on the horizon. At least not one that has been floated out in the media through politics or through anyone else. So it is a pain point. It is one that our clients have learned to deal with. One that we try to help coach them through, but it is a logjam.
All right, a lot of clients looking for that help. Mike Ramirez, who is the EP Wealth Advisors Associate Director of Financial Planning and Certified College Financial Consultant. Thanks so much for taking the time here with us today. Really appreciate it.
Thank you for having me.
Certainly. Well, it is open enrollment season, that time of the year where people shop around for health insurance and adjust their benefits. Individuals and families can shop on the ACA marketplace through January 16th in most states. For health insurance through employers, enrollment periods are set by the individual workplace, but most are typically around this time. We want to zero in on one thing that you might be considering for your health insurance, and that is an HSA account or a health savings account. Now, it's a tax-advantaged way to save for qualified medical expenses, and that all sounds great, but many people tend to misunderstand how this account works and how you can use it to your advantage. Here with 3 common misconceptions about HSAs, we've got Ryan Victorin, Fidelity Investments Vice President and Financial Consultant. Ryan, great to have you on here with Yahoo Finance. First, I just want to read your first 3 misconceptions here. Number 1, it makes no difference where I save money for healthcare costs as long as I save. Explain why that's not true.
Yeah, thanks for having me, Brad. Good to see you. So I think the important thing to understand about the advantage to an HSA is really around the tax advantages, and we call it a triple tax advantage. So unlike a brokerage account that you could just save for, your retirement costs or your healthcare costs, there's, like I said, a triple threat when it comes to HSA. So the first one is the money that goes into your HSA is pre-tax. So it goes into, before even taxes hit. Second, you can use the money in that account to pay for qualified medical expenses tax-free. And the third one is that you can actually invest in HSA so that it can grow. And all of that growth, again, assuming it's used for, qualified medical expenses down the road, is also tax-free as well. So that's the difference between a brokerage account that could be taxed year over year.
All right. Misconception number 2 of 3. I don't want to open an HSA because I don't think I will use the money in my account by the end of the year. And if I leave my job, I could lose the money too. Break this one down for us.
Yeah, this probably stems from what most people have an understanding of, if they don't understand an HSA, is something called an FSA, which is a flexible spending account, different from a health savings account. So with an FSA, it is true. If you don't use it, you lose it. And if you leave your job, you might lose it as well. An HSA is totally different. Like I said before, you can actually invest in HSA to grow for your, healthcare expenses or your retirement needs down the road. So it's not a use it or lose it. That money is yours. And even if you leave your employer, the money is still yours. You can keep your HSA and keep it growing for what you need down the road. So common misconception, but misconception nonetheless.
Okay, that brings us to misconception number 3, Ryan. I don't see the value in an account that only copays and deductibles here. Why is this one of those misconceptions?
Yeah, it's, again, a really common one because people really do think that it's only used for copays or deductibles. But when I mentioned qualified medical expenses, that can mean so many different things. And I'm talking, of course, things like dental plans, vision plans, but also things like chiropractor, therapy appointments, things like braces or contact lenses. It can be used for all sorts of things. And then, on average, we being Fidelity estimates that each person in retirement will spend on average about $165,000 for healthcare expenses in general. So it's going to be more than just copays and deductibles. But let's say that you go beyond that and you don't need that amount of money. It kind of works as a 401k, where as long as you take withdrawals after the age of 65, you don't pay a penalty. The withdrawals will still be taxable like a 401k, but it can be used for other things. So, if you need it beyond healthcare, you can, of course, do that. The difference with the 401k, though, and an HSA is that there are no required minimum distributions. So oftentimes we might have lower healthcare costs early in retirement, but as we get a little bit older, we might need a little bit more support. So you can keep investing it and keep growing it for down the road. So it's a great tool.
Ryan, just before we let you go, your number one piece of advice this open enrollment season, what is it?
Is take a look into HSAs, right? So you can learn more. You can go to fidelity.com/YHSA. So that's WHY HSA. And don't be afraid to ask for help. Ask your HR representatives if it's through your employer and you have that high deductible plan and it's available to you. But also go online and research it. It's a great tool. So go look into it.
Ryan, good to speak with you once again. Ryan Victorian, who is the Fidelity Investments Vice President and Financial Consultant. Thanks so much.
Thanks, Brad.
We've got much more on wealth after the break. Stay tuned. You're watching Yahoo Finance. Every week, Yahoo Finance's Money Glow Up gives you the space to jumpstart your financial journey. Host Tiffany Alichet, aka The Budgetnista, creates a space to share real and inspiring money stories, learn financial fundamentals, and build your future. And this week, Tiffany speaks with financial coach and CPA Tanya Taylor about saving for emergencies when money's tight and more.
So I always tell people to start with like your 3-month bank statement, your 3 months credit card, go through that list. I'm telling you, like preaching to the choir, right? And then identify patterns of your spending. So if you're thinking like I'm really tight, maybe you notice that you have all these subscriptions that you're not using, right? If you cancel those subscriptions, then you're gonna find that money that you'll be able to start using for your emergency fund. So the first thing is, gather your expenses, look at the things that your wants and the things that you really have to have in your budget.
Canceling subscriptions, definitely talking about me there. Step into the classroom with Money Glow Up every Thursday at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Well, every week, hosts and husbands of Living Not So Fabulously, David and John Ottenschneider dive into real money stories with activists, allies, artists, tech gurus, and trailblazers in the LGBTQ plus community to give you tangible takeaways to tackle your wallet woes. And this week, David and John sat down with the one and only Tim Gunn, who talked about financial discipline. Take a listen.
You just have to practice a lot of self-discipline about what you're spending, how you're spending it. I mean, today, and a lot of it has to do with the fact that there's just so much stuff out there and there's so much waste. And I think a lot of people spend money impulsively. And part of it is a high, wanting to achieve a high. Oh, I'll feel great if I buy that.
Right.
But then think of the consequences when the credit card bill comes. And as someone who lived with credit card debt for decades, what a relief it is to not have any.
David and John join me now. Okay, I mean, what did you think of Tim's advice? A lot of people probably recognize Tim from some of his work in entertainment, academics, this, that, and the third. What did you think of the advice?
Well, Tim is not only stylish, he's also funny and wise. And I think what he's really doing here is with our money, he's telling us, just like he did on Project Runway, we have to figure out how to make it work. And when we do, we're going to feel a lot better if we do that.
Certainly. And so we're heading into the holiday spending season. I mean, you mentioned how stylish Tim is, and I think about how much more stylish I want to be and get my family members around me to be stylish, but on a budget. Do you have any advice for our listeners and viewers when it comes to spending?
Yeah, you know, Mariah Carey is thawing out as we speak, and we all know what that means, right? So we got to brace ourselves for the holiday spending binge. And David and I don't want to be restrictive. We don't like to tell people what not to do with their money. We don't want to shame them into financial compliance. But here's the thing: anywhere from 28 to 46% of Americans are still paying off debt from last year. So go ahead and wash down that avocado toast with your oatmeal latte, but we want people to maybe think a little bit more intentional about their money, how they're spending it, and whether or not they're getting true value from their spending, the value that they want to get.
No, that's great advice, John. David, how do I get the most value out of my spending then?
Sure. Well, Brad, you know that John and I are money nerds. We both like the number side, but also the emotional side of money. And so we kind of break this down into a two-step process. The first side is we encourage folks to do a spending analysis, whether that's a month, 6 months, or a whole year. We prefer a whole year because then you get to see the ups and downs in your spending patterns. And so when you do that, you really open your eyes to where you're spending your money. That's the first step. The second step is the emotional side. So we encourage folks to do kind of a Yelp review of those spending categories. Break it down to a 1 to a 5. And when you do that, we call this your return on happiness. If it scores between a 1 and a 3, you're probably not getting the true value or the true long-term happiness out of your spending. If you mark it as a 4 or a 5, that really is what is giving you that true value. But not only that for your money, it aligns with your personal values and gives you long-term satisfaction on the spending you have.
All right, ROI walked so that ROH could run. Thank you so much for joining us here in studio. We've got David and John Ottenschneider. Go and check out the podcast. You do not want to miss their future episodes. Appreciate it.
Thank you.
We're exactly 2 weeks away from Thanksgiving, and for those hosting the festivities this year, under pressure, it's time to start putting together that shopping list and buying all the ingredients that you need. Here with some tips and tricks to stretch your holiday grocery budget, we've got Winnie Sun. She's the managing director of Sun Group Wealth Partners. Winnie, good to see you. Good to have you back on the program. So give us some top tips for making a shopping plan for a holiday dinner.
Yes, Brad, we know that the grocery bill is a big part of the Thanksgiving budget. And so we want to make sure that you not only stretch your budget, but you also have more time to spend with the people that you love. And so first tip is, of course, we all know that it's important to go shopping, number 1, with a full stomach, and number 2, with a shopping list. But before you even decide where to make the shopping list, people will say, well, Winnie, should I just should I text myself a list? Should I actually write it down? Actually, I suggest you go to the retailer or the store that you normally do most of your shopping at. Use that supermarket's shopping cart and actually make your shopping list there.
You mentioned curbside pickup as well here. What are some of your pros and cons of using a curbside pickup service? Say I don't even want to walk into the store. I just can't be tempted, Winnie.
I know, I love this, Brad, because curbside pickup, believe it or not, is my level up when it comes to grocery shopping, because this is where you will absolutely save money. I tell my clients all the time, if you walk in the store, you're going to be losing money, because the truth about it is about 15 to 20% of what we spend in the market are actually impulse buys. So if you streamline your list at home, right, and you cross-reference your pantry, you go through your refrigerator, and you figure out, do I really need that spice? Do I have enough potatoes at home? Then you actually save money and you save time. So you basically go to the store that you want to shop at. Maybe it's your local supermarket. You've already filled up your shopping cart with your shopping list, right, that we did earlier. And then now you can see where the sales are. You can clip those digital coupons even. And then you finish, you pay, and then you simply pick up during your time slot, or in my case, I have my husband go and drive by and pick it up, and then you're done. So not only do you save time, but you also save money. And that's really a big part of it. Now, I will say one of the cons of doing this, of course, is that you need to plan ahead a little bit. You can't really all of a sudden, I need butter and I need to run. I can just put this in curbside. Usually it doesn't work that way. There's usually a minimum, and then you need to plan ahead. Usually an hour or two is usually reasonable. And then you're done.
You're spot on with those impulse purchases from in-store. I mean, 97% of my vases and planters are definitely impulse buys. Some grocery stores are offering meal deals, we know, Winnie, where shoppers can find good deals. But where from your own calculus and your own reviews can shoppers truly find the best deal?
Well, Brad, it depends on what you want on your Thanksgiving table or your Christmas dinner, whatever it may be. But here's the thing. There's so many retailers now competing for your business. So they're bringing on some pretty substantial deals. Now, if you want a full spread Thanksgiving, it doesn't have to break the budget, because Target actually has a meal for four for $20. Then we're talking Walmart has a meal, turkey and all the fixings, for about $40. And then places such as Costco, Sam's Club, you're talking $60 for something a little bit more elaborate. So definitely take a look, because a lot of these retailers are selling, sometimes we're even seeing turkeys for 99 cents a pound. So look at the different deals. These are sort of their throwaway deals that the supermarkets are doing, so that they can get you into the store, so that you can actually spend and do a little bit of impulse shopping.
All right, just briefly with the time that we have left, how can shoppers utilize perks from grocery rewards that they've been saving up, and grocery rewards credit cards specifically?
Absolutely. So, Brad, one thing you want to do is take a look at the credit cards. Some of your credit cards give substantial cash back. So we're talking Amex has some really great cards, like their blue. And then they also have the Amex Gold card as well. And then Citi, almost all the credit card companies, including Chase, have a credit card that can actually earn you either cash back or even travel miles. So take a look at that.
Winnie Sun, thank you so much for taking the time here with us today. Good luck to you as well, putting together the big feasts, the big dinners. You've got all the tips. So I look forward to checking back in after the holidays as well.
You bet. Thank you. You too, Brad. Take care. Happy holidays.
Same to you. Let's do a final check of the markets as we're taking a look at the U.S. major averages here on your screen. The Dow, the S&P 500, and the NASDAQ in negative territory right now, as you're seeing the Dow down by about 0.25%. We'll round that off to S&P 500 about the same on a percentage basis. The NASDAQ composite, that's down by about 0.2% here. Also, just taking a quick look here at my screen, I'm pulling up some of the sector activity, especially as we've been tracking very closely up against some of the earnings reports that have been coming out over the course of this week and here today. Plus, keeping tabs on Bitcoin. Since Bitcoin is up, we'll show you exactly what's taking place there. It's down right now by about 3.9%. Sector basis, you're seeing industrials lead the decline, technology holding up well. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close.